shift is already happening. It's your move now.
Good. All right, everyone. Hello, hello, hello. Happy weekend. To check if you can hear me well, can you just write where you're from? Just for me to check the audios. Hello, yeah, lots of folks are in the room and they are calling from so many places, mostly Singapore, Australia, US, Europe there, Manila, Malaysia, very loud and clear. Israel, okay. Nigeria, South Africa, lots of countries now in the headlines, right? So interesting to watch CNN and hear on the news. And Trump is, an entertainer every day. Italy, Mexico, also, right? Johor. I just was just in Johor last weekend. Great place. All right. So good. Looks like everyone can hear me well and welcome you all. And this is the Retail Rebellion 2025 webinar. And I know many of you are not joining us from different time zones. Some of you could be in a very late time zone. Some of you could be in very early in the morning as well. And of course, many of you are in the Sunday afternoon, which I really appreciate your time. Thank you for joining in and your overwhelming support. And thank you for your commitment to use your weekend time to learn. I can't wait to share my knowledge with you today. I trust you have enjoyed the webinars by Adam and Ausen yesterday, and also earlier today by Adam himself. Before I get into my webinar content, I just want to put up a disclaimer here to make sure that we are clear that I'm not the licensed financial advisor, so I won't be able to recommend or suggest you to do certain trades. What I've been doing, that's what I'm going to share. So based purely on my experience and on my knowledge, and you will need to do your own due diligence because before you take any trades for yourself, right? Because beyond this today webinar, we will have the live trade hunt webinars during the week as well. All right, with that said, I just move on to the agenda for today. Earlier today, Adam have talked about how powerful options can be if you know how to use them properly, right? Both from the investor's standpoint and also from the trader's standpoint, right? Especially Adam talked about selling options, selling put options uh, to earn the consistent profits. And he's shown that he make hundreds of thousands of dollars every year selling put options. This is a concept of selling insurance, which has a high probability of winning. As you always know, insurance company win most of the time. He also talked about selling boon put spread, which can be a very powerful strategy for those with small accounts, for those who do not want to own shares, a concept of selling insurance, but also buying reinsurance at the same time to protect yourself from any catastrophic event, right? So that is also another powerful option strategies that you could use as well. He also talked a little bit on the bullish synthetic spread, where he buy a call and sell a put at the same time for essentially zero cost at the entry. You can use these strategies as a proxy for trading stocks, but you use a fraction of the capital, right? 1/4 of the capital. Now, just to be clear, when you use 1/4 of the capital for the trade, it doesn't mean that your risk will be 1/4. You will be risking the same amount of loss if the share price moves down, right? As if you are using shares. So the risk reward profile is exactly the same as if you buying 100 shares, right? So it's not like 1/4 of the risk, 1/4 of the capital, but the risk is the same. Yeah, just to make it very clear upfront there. Now, he talked a lot about, concept of options. For those of you who only heard about options today for the first time, and you could already understand about 50% of what he said, I can tell you that you are a genius. All right. But if you could understand only 10, 20% of what he said today, you are completely normal. You are completely normal, right? So don't feel overwhelmed. It took me many years to really understand options inside out. I'm not saying I 100% know how it works. There's still something that I'm still learning, but it took me quite a while to master it, right? And for you who just started this journey with us, don't worry. We designed this mentorship program in a way that we can hone your hands step by step. We have very regular webinars live by Adam, by myself, by the coaches, YY, and other coaches as well, so that we can help you get on board and understand options the fastest that you can, right? Since Adam has already talked a bit on the put options, right? How it works, stuff like that. In my webinar today, I will focus on the con side of the option. Yeah. And then I would jump into one strategy that I have used a lot and that has contributed significantly to my profits over the past few years. And that option strategy is called calendar spread. So this is one of my favorite strategies, right? So in today's webinar, you see that I will show you how to use option to magnify your return on investment in the current market environment. And within that, I will share with you my trading results so far, and just for you to have an idea on how option can help boost your return on investment. Yeah. In particular, I will share with you this one strategy, calendar spread, that can benefit you in the context of the market price or the stock price is not going anywhere, right? So this is a very dynamic, very versatile, and very powerful option strategy that you can use, and also show you how to construct a calendar spread step by step, optimal entry and exit rules, and key benefits and key watch outs for the strategies. Right. Towards the end of the webinar, I will also share with you my top 3 trading ideas using calendar spread right now. Of course, when the market opens on Monday, and particularly on Wednesday when I have a trade hunt webinar, the price can change and I will need to refine the trades. But I just share with you my top trade ideas based on the data as of the close of last Friday, right? And I will also answer the questions that you may have. Please send it over to the Zoom webinar here under the Q&A tab, all right? So those are the items that I plan to cover today, right? Anything else, let me know along the way, all right? So a little bit on myself in case you don't know me yet, right? We're talking about retail rebellions, and I can tell you that I'm a typical humble retailer. I'm not like Alson, who used to come from the trading desk side the market maker side. So I'm not. I'm just like many of you. I used to have a full-time job. Many of you know. I talked a little bit on the Outlook 2025 earlier this year. I um, I worked for Procter& and Gamble for 28 years, and I retired about 2 years ago. Yeah. So before my retirement, I still remember I was juggling between a full-time job, which is very busy in the daytime shift, and also trading activities that I had during the nighttime shift. So I call this is daytime and nighttime shifts. And I love both of the jobs, right? I love my daytime job. I love my nighttime jobs as well. A lot of passion for it, and very rewarding at the same time. Yeah, but when I'm getting older, it's a little bit difficult to do both at the same time. The daytime job, getting more heavier and heavier every day. Lots of night calls, sometimes crossing midnight as well. Uh, so and I have two kids, right? Family, quite difficult for me to do both at the same time. And I show you some numbers later on. My incomes from trading also become very important, even like exceeded my employment incomes many times over. So then I say, okay, it's so taxing to do both, right? So it's time for me to focus on only one, that the one that I love. The other one I also love, but this one I love more right now. So that is trading and also coaching and training as well. So that's the reason why I decided to retire 2 years ago. And I'm now the options trading strategist at Brenner Profits. I have 25 years of trading experience, starting with stocks trading before I got to know options. But when I know option 20 years ago, I never looked back again using stocks. I only trade options since then. I believe Adam also now only trade options. He rarely trades stocks. And over the past 9 years, I've been partnering with Adam and Alson and the whole PP team there to provide the option coaching service. Yeah. So why do I like trading option? Trading option, unlike trading stock, you when you trade stock, if you want to make a decent profit or you have a decent size for the trade, you would need to use quite a large amount of capital, right? We're talking like maybe tens of $1,000s per trade, which is quite significant for those who just started. Unlike that, option trading doesn't require a large capital. Some trades you can just use, as little as few $100s, right? And you can has exposure to 100 shares kind of thing, 100 equivalent to 100 shares. And because you use much less capital for a trade, but you could generate the same or almost the same returns on the same trade. Imagine that it could boost your return on investment significantly. That's why this is one of the reasons why I love trading option, and I use it for my trading on the time, and I generated um, outstanding return on investment compared to the markets, which I will show you later. Yeah, we will talk a bit on the power of the options. Adam already touched a little bit on it on different strategies, but I will explain a little bit more later today. Yeah. Now, very importantly, trading options is suitable for many different traders' profile. Like me, busy professionals 2 years ago, and before that, I was very busy, but I managed to do both, right? Daytime. Luckily for us in Asia, we can still focus on the daytime job, and when the US market opens, then I can jump in and do another business for myself, which is a trading business. So for busy professionals, you can do it. Now, for my type of trading, you don't need to like watch your trade like a hawk every minute or so. No, you don't need to do it. It's not like scalping, it's not like swing trading or something like that. This is something like you enter and then once every day or once every 2 days you can look into your trade and see if you need to take any action. It's not like you have to glue your eyes on the screen. It's not that. So totally suitable for busy professional, right? Active traders definitely love trading options. There's so many combination, different way to construct a trades to fit to your theory. So active trader will definitely love it. Traders with small accounts with few $1,000s to start with, you can definitely have a good, a number of trades for your portfolio, right? You don't need to have hundred of thousands of dollars or millions of dollars account to trade options. Yeah, of course, when you want to scale your business to make serious money, you need to have a bigger account. Yeah. Now, speaking of accounts, right? Let me just show you a peek at my trading accounts. So this is my main trading account in IBKR. So I call it IB main account. So over the past 1 year, July to July, I generated in this account $330,000 profit, 32.9% return on investment, and that is double of S&P 500 return during the same period of time. And then on my second Interactive Brokers account, I also generated some decent money here, $257,000 profit over the past 1 year. This one, 39.57%, obviously more than double of S&P 500 returns. So if you just look at these two accounts combined, I generated $587,000 profits in 1 year and with an average return of 35.52%, and that is 2x of S&P 500. Yeah, so you see, option can be very powerful and it can help you boost your return on investment significantly. I'm talking about 1 year here, but if you look at my main account, the one that I showed you at the beginning, over the past 6 years. Why 6 years? Because 6 years is where I started the account, right? Let me open my drawing tool also so that I can draw something. All right, so I created this account on 11 July 2019, so 6 years ago. So today is July 2025. So 6 years has passed, and over that 6 year, I have grown my account from this net capital. Of course, I have deposit and I have withdrawals as well. But net, my capital in the trade is this amount, right? $657,000. This is my capital. Over the past 6 years, I grew it to 1.33 million US dollars. So that translates into a profit of $678,000 or a return on investment of 240.51% over the period of 6 years. Yeah. And if you look at the chart here, the green line is S&P 500 and the blue line is my account performance. So I got 240% here, and S&P 500 is up, I think, 114%. So obviously, I more than double the S&P 500 over the past 6 years. Now, not just 1 year, not just 6 years. In between, you can see here that same account, I consistently double the return of S&P 500 over 3 years period, right? Over 5 years period, I also double the performance, and over 6 years periods, I also double the performance. So very consistently beat the market by 2x. Now this slide I also shared during the Outlook 2025 event in Marina Bay Sands, I show my profit last year on 100% from trading options, right? So I'm not talking about REITs investment or property, that's something else. This is just purely from my trading accounts, and that's all option. So over last year, 2024, I generated $1.2 million profit, right? 64.6% return on investment, and that is more than 2x of S&P 500 in 2024. And before that, the year before that, 2023 here, I also generated about $868,000 and a return of 84%, and that is 4x of S&P 500. So you can see that option can help boost return on investment significantly. You just need to master your skills and use option skills to make money for you. And with this kinds of income, it's more than enough. So I'm sharing with you these numbers, not just to brag, right? It's not just to brag, like, my account and stuff. Like, no, it's not. It's just to show you that what I'm teaching is what I'm practicing at the same time. So I'm doing what I'm teaching. So I have the real skin in the games. So I trade with serious money and I make serious money, serious profits as well. So it's not like in theory kind of paper. Adam mentioned in his webinar, I think we are the only one in Singapore who show our real accounts, real numbers, right? And we do what we teach, and that is the power of that. And not just making money. Sometimes you need to realize your money as well, because money that you made in the account at the end of the day is still a paper money, right? Paper profit. So many of you may know this one. Earlier this year, I cashed out $1.115 million, almost, yeah, more than 1.1 million US dollars out of one of my accounts. So I closed down one of my accounts, just cash it out. When you had a good year like last year, this one I cash out almost the entire profit I made last year. I think I made 1.2 something, so almost there. So I cash out the money because I need the money to buy some property, right? This is something that my wife can handle, right? She is tangible. She can do what she can see, right? So she has no clue what I'm doing with options. So you got to make sure that that I take some chip off the table, realizing some paper profits and lock it in and convert it into something tangible, and so my wife can manage it, right? So this is our discipline, right? Sometimes you just need to be disciplined on the way you trade, and you make profit. Just realize it, lock it in, so that you can just play with the house's money. Yeah. So that's how I have done, right? I will continue to cash out some of the profits this year. That's what I'm planning. I don't know yet. We need to see the year how it ends, and then I will probably cash out something else to again buy some other piece of property, which my wife can manage it. All right. So again, this is something that I do, right? And I think I recorded this cashing out video, and I put in the curriculum. If you sign up on the mentorship program, you can see this video as well, guiding you on how to withdraw money from your broker accounts, and the step by step, and then some watch out and stuff like that you have to take care. Yeah, because a lot of you tend to just like inject capital or transfer money in, but not many of you actually cashing out the fund from the account. So there are something that you need to know as well. All right. So having said that, let us now jump into the content of today's webinar. I touch a little bit on the power of options, and I talk about it now. So for options, right? Options can be used by different traders profile, right? For investors, you can use option to hedge an investment, right? So if you really want to have a peace of mind, right, and then you see something very concerning in the horizon and you want to have a peace of mind, you could buy a put option to protect your investment, right? Normally, if for long-term investment, people don't care. Like Adam, he never does it. But for some of you, if you are so scared that you need to have a peace of mind so that you could have a good sleep and you can focus on your daytime job, it's okay to buy a put option to protect your investment for a short period of time, not just for a long period of time. It's like when you buy an insurance for your house, for your car, for your health, things like that, right? I don't invest. I only invest in REITs in Singapore, which have no option anyway. So I never buy any put option to protect my REITs because I cannot do it, and I don't plan to do it anyway. But for US markets, I don't have any stock holdings, so I don't hedge. But for some of you, just let you know that we do have lesson in the curriculum to tell you, explain if you want to hedge, how much you need to hedge and how to hedge it, right? So that's one thing you can do with option. You can also generate extra income from the stock holdings you are holding anyway, right? For I know some of you could be holding a lot of stocks, big positions. Some of them are doing very well, like growth stock and stuff like that. You don't sell cover call because you let the stock run to earn on the upside. But for some like cyclical stocks or some like steady blue chip kind of stocks, when you don't where you don't expect a huge rally, then you can think about selling call option, yeah, to earn extra income. For example, if you are sitting on some like Pepsi, like Johnson, Procter and Gamble, or even Apple, you don't think the stock price will fly anytime soon, just keep selling call option to collect premium, especially if your stock holdings are sitting on some nice capital gain already. Yeah, so your cost of holding the shares is low. Now you sell at the high strike prices. So in the scenario where the stock price goes significantly higher, you don't mind selling your shares at the strike price of the call option. So that's something you can do as well for investor, right? And this morning, Adam talked about using put option to potentially buying fundamental fundamentally good stocks at a discount, right? So he talked about, I don't know what stock he quoted, but let's say if we use it on a discount, like Google, for example, is undervalued right now. Fundamentally, is a good stock. It's okay to buy at the current stock price, but you want to play hard to get, so you can sell a lower put strike option to potentially acquire the stocks at the lower price, right? So if the stock price doesn't get to that level, hey, you collect premium for free. That is a cash secure put concept that Adam talked about earlier today. Yeah, so those are the strategies that you can do for as an investor. Now, for traders, you can use so many different option strategies to generate profits regardless of market conditions, up, down, or nowhere. And one of the strategies I'm teaching today is the calendar spread that allows you to take advantage of the consolidation or sideways pattern, right? So when you trade stock, as I say, you could have to use a lot of capital, right? But if you use option, you use much lower capital. And therefore, it can magnify your returns significantly. And not just that, if you use a lot of capital to trade stocks, even if you put the stop loss to exit your stock position, you will not be guaranteed. will not be guaranteed to exit at that stop loss, because there will be scenario when the stock price open gapping down significantly, like 11 Health over the past few days. It gaps down like 10%. The day after, it gaps down another 6-7%. So in those scenarios, the stop loss that you put there doesn't help, right? Because when it opens down significantly, you will be sold at a lower price, not at your stop loss. But if you use option, it's guaranteed, right? If you construct your trade with the predefined max loss, you will not lose more than that. You will not lose more than that, even if the stock price gaps significantly down, right? So that's what I like about option as well. And last but not least here, you can use option to construct different trades with different win rates. There are ways for you to construct high probability winning rate for the trade. So cash secure put is one, right? Adam shows you, you could have like 70% win rate for cash secure put or for bull put spread, right? The bullish synthetic is 50-50, right? But there are other strategies like, iron condor, you could have like 80% win rate if you want to construct that way, or there will be 95% win rate for some strategies as well, right? So bull put spread extreme that Adam designed, that one has 90% win rate, right? So we have different win rates for different strategies, and it's so powerful and so flexible, and it's up to your risk tolerance. You can choose different strategies for your own liking. Yeah. So that is the power of the options. Now, this morning, Adam talked about put option a lot. Yeah, we talk about call option as well when he talk about the bullish synthetic, but not much. But let me cover the call option now. For those of you who have no idea what call option is all about, so let me explain to you. A call option is a contract that gives you the right to buy 100 shares at the strike price on or before the expiration date. All right. So a lot of wordings, mumbo jumbo thing here, but keep it simple. When you want to buy a property, you put up a deposit, and that deposit locked in the price that you can buy your property, right? So if you want to buy, let's say $1 million worth of property, and you put up 50 grand as a deposit, that 50 grand deposit allows you to lock in $1 million price. Even the property developer has not built the property yet, and it could take them like 2-3 years to finish. And by the time the developer delivers the key to you, the property price could go up a lot, right? But you are locked in buying the property at $1 million, so you don't have to pay higher. So that is a concept of calling a call option. Yeah, you should just put up a deposit there, and it allows you to lock in the price. So keep it that simple. Now, call option, like put option, call option has very similar piece of data. It has a underlying stock, right? When you want to buy, what kinds of stock you want to buy. So in this case, I just use Google, right? Google GOOGL, right? So that is underlying stock. So you want to buy 100 shares of Google, right? So that is the call option you want to buy, and you buy the option that has expiration on 16th of January 2026, which is roughly about 182 days from today, right? And you want to buy at current stock price. I think Google right now is 185.03 or something, right? So you want to lock in the current price, yeah? And you buy a call option, and you will have to pay a premium, which is like a deposit. Now, when it quote 17.78, that is per shares. But when you buy a call option, that is equivalent to 100 shares. So the quantum that you need to put there for the premium is $1,778. Yeah, so times 100, right? So if you buy one call option like this, What does it do for you? Well, it will lock in the price that you can buy Google in the next 182 days, right? So in the next 182 days, if the stock price goes to 200 to 300, do you need to pay higher? No, you pay only 185 because you are already locked in the price. Now you have the right. But if you don't like to buy Google at 185, you can only just simple walk away from it. But what you lose $1,778 premium. So that deposit will be gone. Yeah. So this is the concept of buying call option. You buy a call option, you have the right to buy the sub price at the strike price. Now, sometimes you choose 185, sometimes you choose 190, sometimes you choose 180 as well. So we explain the differences among those strike price in the course, right? But just keep it simple. You buy at the current stock price right here. So then the question is, why don't you just buy the shares, right? Well, buying 100 shares today at the current stock price, you will need a capital of what? $18,500, right? So 100 shares, you need $18,500. You say, okay, I think I will have that money, but not now. I will wait for my year-end bonus, right, to come in, and then I have the cash amount to buy 100 shares. So in the meantime, I see Google at the current stock at the current price is a good deal. Is a steal. I don't want to miss it. I don't want to miss it, but I don't have enough cash to buy. I don't want to borrow the bank because I have to pay interest rate as well. So I will wait for my year-end bonus to buy. So how do I guarantee that I could buy at the current price? Well, then I will need to buy a call option here. However, for you to have that right to buy 100 shares of Google at 185 and allows you to hold that right for the next 182 days, you will need to pay $1,778. That is something that you have to consider. Yeah. So it's not for free. You don't just put the deposit and then it will it's some slightly different versus buying property. Buying property means you can use that deposit to offset the future payment. This one is not. The moment you buy, that money belongs to the seller. Yeah. So you don't get that money back unless you can sell your share at the higher price. All right. So now, if you are the buyer of that call option, what does it do for you, right? If the stock price goes up as you expected, right? You think the stock price is so cheap right now, so it will go up, and upcoming earning will be good and stock price will fly. You will lock in the price right now. Now, if you are right and the stock price goes above the break-even point, what is your break-even point? Well, that is the price you agree to buy, 185, plus the premium you pay. Again, this premium is not like can be used to offset the future payment like the deposit does. This one is not. It will be an additional cost for you. So the total cost of buying 100 shares for you is not 18,500, but 18,500 plus 1,778. Yeah. So therefore, your total cash outlay in this deal when you exercise to buy 100 shares is 20,278. That is your cost. So if the stock price goes beyond that, if the stock price goes to 203, yeah, you make money. If it goes to 205, yes, you make money. Goes to 210 to 210, of course you make a lot of money. Yeah. But if the stock price goes up slightly, let's say it goes to 190 by January 2026, guess what? You would still be losing money. Yeah, because your total cost is 2.78, not 185. And now the stock price goes to only 190. It's still below that cost. You will be losing money. Yeah. So if you buy call option like this, you have the right but not the obligation to buy the share. So one of the reason why people want to buy call option also is in case they are wrong, the stock price doesn't go up. It collapses. Let's say it drops to $100. Guess what? You're not losing a lot. You're losing the premium you pay, which is 1778. That's it. All the money you lose in this is the premium you paid. So even if the stock price collapses, you're not losing on the way down. Unlike trading stocks, if the stock price gaps down to $100, you could lose a lot, right? You could lose like $85 times 100. You could lose $8,500 if it gaps to $100 for some reason. Yeah, but if you buy a call option, your max loss is equal to the premium you paid. Yeah, so that is the scenario where you lose the premium or you lose the max loss if the stock price stays below the strike price. In this case, it stays below 185. And then on the $1,778 you pay will be gone by the time of the expiration. So we lose your premium. Yeah. All right. Now, what is the advantage? What are the advantages of using this strategy, the buying call option? Well, people get lured into this concept of buying option because it has potentially unlimited upside potential. It has potentially unlimited upside. That's why during the meme stock rally, people keep buying call options because there's no limit to the upside, right? GameStop went from $10 to $100+ in a matter of few days, right? So you see AMC, you see a lot of meme stock triple or 10 times within a matter of few days or few weeks because it has unlimited upside potential. So that is a very attractive idea. Lots of new option traders, rookie traders, uh, get lured into this concept, and they say, okay, why don't I just buy a call option, paying a little premium, and I know that's my max loss, but I have potential unlimited upside. So it's like I want to buy a lottery ticket and I could potentially win a big prize. It's the same concept. Yeah. And if I'm wrong, the stock price collapses. Guess what? The loss is limited to the amount of the premium I paid. That's it. I cannot lose more than 1778, even when Google share price goes to zero. Yeah. Now the disadvantage is this. When you buy an option, so in this case you buy a call option, time decay works against you every single day. Okay? So when you buy an option, you will face with the premium decay every single day towards the expiration date. So for you to make money in this call option, right? The stock price has to go up fast enough for you to overcome the time decay in the option. It's like when you swim against the current, right? If you go, like if you swim fast enough, like 2 meters, and then the current push you back by 1 meter, so you net off like still up by 1 meters. So if you are like lucky, you get in the very strong momentum stock, you can do it. I mean, the magnitude of the share price going higher overcomes the time decay effect. So in that case, you could still make money, right? So you are very professional swimmer. You can swim against the current and you can still reach the destination. But I tell you, many of traders not a professional swimmer. They swim against the currents on the time and they get lost. Yeah, because they get only like half of the meter and then the current push them back 1 meter, so they losing money on the time. And that's why buy a call option like this has a low probability of winning. And I will show you in a minute what is the probability of winning. And I call it a losing game. Buying a call option is a losing game. However, it is sadly that most people do it. And most people lose money. Okay, so let me jump into the platform and show you this particular contract of Google option. So I have here Thinkorswim option. Thinkorswim, I type in GOOD in the ticker symbol, and under the option chain, I open up on the option chain, right? You see, you can see there are many option series for you to trade. That's the beauty of options. You can choose so many different expiration for you to trade. So let's say if you select January 2026 here, 181 day, and you choose to buy a call option. So call option is in on the left hand side, and put option is here. Yeah. So you want to buy a call option, and the stock price right now at 185.06 as of last Friday. Yeah. So let's round it down to 185. And you want to lock in that stock price at 185 by buying a call option at the strike price of 185. And for you to do that, you will have to pay a premium. And look at the mark column. Mark column means the mark price, the market price of this option. So you want to buy a call option at the strike price of 190, sorry, of 90, wrong. At the strike price of 185, and I buy the one that expires on 16th of January 2026, which is 181 days from today, for which I have to pay $17.78 per shares. So one contract means 100 shares. I will have to pay 1778. Right? So that is a premium I have to pay for buying this call option. And it allows me to lock in this price for 181 days with the hope that the price will go much higher from here. So that's a buying call option. Now, if I do that, I buy and I analyze the chart of the buy single call option here. So here's a chart of that particular option. So I move this date to the expiration date, which is on the 16th of, sorry, not this one. This is on 16 of 16 January 2026. So I choose the day after that when the option is settled. Yeah. And let me show you the P&L chart. So sets break even point for the expiration date. So this is the P&L chart. Maybe I hide this one, make it bigger. All right. So based on this, right, you see the current stock price is here, which is about 185, right? 185. And for you to make money, the stock price needs to go on the way to 202.8 or something, right? The break-even point, which is 185 plus 17.78. That is the break-even point. So that is zero line. Above zero line is a profit zone. Below that is a loss. Yeah. So you will only make money if the stock price goes beyond this break-even point. So from this onwards, you will be making money here. Yeah. So this is the profit zone that you have. So you need the stock price to move fast enough to go beyond the break-even point for you to make money. If it stays here until the expiration, you will lose on the premium, which is 1,778. That is a loss at the expiration. Yeah, so this is a loss. Now, guess what? How many percentage of winning rate do you have for this particular trade? Well, the system tells us that you have only about 35% chance of winning, and you have 65% chance of losing money. So that's why I say buying a call option is a losing game. The odd is against the buyer of the option. And for that reason, Adam and myself, we don't advocate buying a call option alone because this is a losing game. You will face time decay every single day. How much is the time decay, right? Per day. Just give you an example. If the stock price stays right here, right now, the time decay, which is called theta, will be $5 a day. So every day, weekday or weekend, doesn't matter. When you wake up, you see your option value decays by $5. Yeah, $5 a day. Now, this $5 a day will not stay constant. It will accelerate, meaning the closer to the expiration date, the decay will be faster, and therefore you will be losing more towards the expiration time. So let me simulate it for you. So today is 20th of July, right? If I move this one towards the future date, you will see the theta increases. Yeah, so theta will increase towards the expiration date, right? So the closer to the expiration date of the option, the more option will lose every single days, right? So that's a point in time, you'll be losing $6 a day. By mid of October, you will start losing $7 a day. Yeah, so by mid of November, you'll be losing $8 a day. By mid of December, will be losing like almost $12 a day, and it keep going up until you reach the expiry date. You see, the closer to the expiration date, the less hope you have in the option if the stock price continue to stay at this level. So you have less and less and less hope. So the hope value is decaying every single day. And that is a time decay in the call option if you buy a call option. I hope it's clear, everyone. Yeah, I hope it's not too complicated. Yeah. All right. So that is what we say. Buy a call option is a losing game. However, most people do it because they do not have a proper education on options, the right way to trade option. Now, I don't blame them because I used to be like them. In my first 7 years, this is what I did as well. And I lost money most of the time. I did not have the right, I did not have the proper training on option at the beginning. I just do like experiment, try and error by myself. And I lost money most of the time. And I think I told the story. One day I lost. So there was time, I think 2006, and when I was in Jakarta, I was posted there. So I live in Jakarta for 3 years. So during 2006, you know, Apple's stock price went up almost every single day. It's like Nvidia right now. And because they introduced iPhone before that, and it become a hot cake. So Apple share price went up almost every day. So like meme stock, the stock price went up like crazy. So what I did, I just bought call option every single day. Every time I have some money saving, some money that I save, I put in the call option. And I collected a lot of call in my portfolio. So at that time, that point in time, if you look at my portfolio, there's nothing but Apple call options. And there was one day And there's always one day when the news that Steve Jobs got hospitalized and the stock price plunged. And that one single day, I lost $60,000, 60 grand in one day. I think at that point in time, that was my biggest loss in my trading career. Yeah, so just tell you that I used to be in the other side, the losing side. Yeah, because the lack of education, the lack of understanding of how option works. So if you buy call option, especially on the high momentum stock, the premium is high. You need the price to go up almost every day to make money. It's like when you swim against the current, and current is very strong. You need to be a very strong swimmer to go against the current. But if one day you suddenly in one moment you get tired, you could not swim anymore, and then the current just dripped you down. And that's what happened to me in one single day. So again, when I say it's a losing game, and I say sadly many people still do it, I myself used to be like them, but I learned from my mistake. I learned from my mistake, and I learned it properly. And since then, of course, I make a lot more money to overcome that memorable loss. All right. So everyone, don't buy single call option because it is a losing game. Leap option, somebody asked about leap option. Leap option technically is the same thing. Leap option is is better. It decay slower, but it's also expensive. It's almost like holding shares. So if you are wrong on the direction, you could lose a lot. So the problem with leap option is the premium is so big. So you have a lot to lose. Unlike shorter DTE option when it is cheaper. This sleep option is a hybrid between holding shares and holding call options. Okay, Chap say, do you do zero DTE? It's tricky one. Maybe in the other venue I will talk about it. I don't want to open the Pandora box right now on the zero DTE. Pullman cover call, I did it. So it is called diagonal spread. It is part of the curriculum that we teach. So we do have cover call and we do have the diagonal spread. So we do both, right? Pullman's cover call is another name of diagonal spread, which we cover, right? And I even created the DS hammer, which will cost you less. So half of the traditional Pullman's cover call. So it's like even poorer man cover call or budget cover call, right? So that's what I do. Okay, so okay, hold on. I just introduced one part of the call option. I haven't finished my lesson yet. Just like one third of it. Okay, so I just bear with me. I still have part two, part three. All right. So when you buy a call option and then suddenly the supply goes down, you will immediately lose option. So, and it's a fool to exercise the call option. Let's say I buy a call option of Google at 185 strike price, and tomorrow there will be some news, and then stock price went down to 150. Why in the who in the right mind would exercise the option? Why you want when you exercise the option? That means you agree to buy Google at 185. And that is the stupidest thing you can do. Why you want to do it? The stock price now drops to 150. Why don't you go to the market and buy at 150? Why do you want to exercise your call option and buy at 185? That is the wrong play. That is a stupid thing to do. Yeah. Yes, you can buy a call option. You can still break even or make money if the stock price goes up fast enough. So in this case, it needs to go beyond 202.78 by the end of the expiry date, which is on 16th of January 2026. So again, you can still swim against the current as long as you swim fast enough. Yeah, but it's harder. It's very hard. not many trader can be that strong, right? So therefore, most people get drifted down by the current. So this is the part one of my lesson. Okay, so hold the horse here. I still have part two and part three. Okay, now let's look at part two, which is another call option. Right. So we talked about the long expiry option earlier, 181 days, the one that expires on 16, right? 16th of January. Now look at another con. This one will be expiring sooner. I still look at the same stock, which is Google. I still look at the same strike price, which is 185. But the difference is I will look at the option that expires at the shorter date. So because the option will have less time to expiry, the value of the option will be lower. So imagine there's a hope value, right? So where you have 181 days to hope, the hope value is greater. Now, if you look at an option that has only 4 weeks or 28 days to hope, right? Then the hope value will be lower. So look at this call option, same stock price, Google, but this one will expire on 15th of August, which is about 4 weeks from now. And same strike price, same call option. This one I would have to pay lower premium if I buy. But if I sell this option, I will collect $775. Yeah, same thing, right? The only difference is the timing and therefore the premium or the hope value. Now, so in the second part of my lesson here, I put myself in the role of a seller of the option, not the buyer. Because you, as I said, buyers of call option is losing money most of the time. Right? So it's a losing game and don't do it. Earlier today, Adam talking about being a seller of option, you have a better chance of winning, like the concept of selling insurance. Time works in your favor. Time works in your favor. It's like Warren Buffett selling put option to buy Coca-Cola stocks at a lower price, right? Same concept. So Adam had done it many times in his trading option as well. He's sold put option on the way. Sometimes he sold call option as well against his stock holding. So let's say if you want to sell a call option and same strike price, 185, you want to sell an option that expires in a shorter time frame so that the time decay will be faster and that it works in your favor, right? You don't want to sell an option that expires in 3 years or 1 year because that time decay will be very slow. When you sell an option, the ideal timing is to sell anything less than 45 days because 45 days and below, the time decay will be accelerating. I showed you earlier, right? As the time moves towards the expiry date, the time decay will accelerate. And therefore, as a seller, you want to sell a shorter expiry date option. So we call it DTE. DTE means date to expiry. Okay, shorter DTE option. So look at that call option. You sell 185 strike, but expiring in the next 4 weeks. Right, August 15th. You collect $7.75. Now you are the seller, right? Your counterpart is the buyer. The buyer, as we understand from the previous example, the buyer, for him to make money, the stock price will need to go up significantly beyond the break-even point. The break-even point for him, your counterparty, is 185 strike price plus the premium he pays, which is 7.75. So his break-even point is 192.75. The stock price has to go up beyond this level in the next 4 weeks for him to make money. Now you, as a counterparty, the seller, is on the opposite side. If the stock price doesn't go up beyond 192.75, you will be profitable. Your break-even point is the same, but if the stock price stays below that, you will be making money. If it goes beyond that, you will be losing money. So that is the dynamic between the buyer and the seller of the option. So as a seller now, you put yourself in the seller's shoe, right? The call seller has obligation to sell your shares at the strike price. So if you own 100 shares of Google and you sell 185 strike price call option expiring in the next 4 weeks, you collect 7.75, and then share price goes higher, you have the obligation to sell your share if it stays above the strike price. But because you collect 7.75, your actual selling price is 192.75, because the 7.75 is the money you keep. You don't have to return that money, right? So you will exit your shares position at 192.75. Now, what if you do not own any shares of option of Google? What happens? Well, then you have to go to the market and buy 100 shares, whatever, at whatever price, and give it to the seller, to the buyer of the option. So therefore, don't do it. Don't sell naked call option, because that means if the stock price goes up a lot, you could lose unlimited amount of money. So if you are the seller of this call option, you will earn the premium if the share price stays below the 185. Yeah. If it stay above 185 but below the break-even point, you still earn some money. So you need to pay back the 775 is something you collected, but when you close it, you have to pay back some premium. So the difference is your profit. If the share price goes beyond 192.75, then you'll be losing money. But if the stock price stays below 185, the premium you collect there, 775 is your profit and your max profit. You cannot make more than that. Yeah. It's like an insurance seller. They make profit from selling insurance premium, right? And the premium they collect is their max profit. They cannot make more than the premium they collect. Exactly the same concept. Now, what is the advantage of selling call option like this? Well, unlike buying option, selling option, you have the time in your side. Yeah. So time decay works in your favor, and you will have a decent probability of winning, which I will show you later. What is a probability of winning for this particular contract? Maybe I show you now. So look at other option. Let's open up August 15, which is 27 days from today. And we also look at the call option here, and we want to sell, let's say 185, and mark price shows that you can sell it at 775. So you collect $775 for one contract, right? So that is a market price. So let's analyze that trade. Sell single. Analyze the trade. So look at that sell option here and move it to 775. What is the P&L profile for your trade? Your trade now will expire. Let me move this one. On 15th of August, right? 2025. So move it to 16, the day after when the option is settled. So what is your date today? Today is July 20th. Yep. Right. So this is the P&L curve for the selling call option here, assuming you don't own any shares. You don't own any Google share and you just sell a call option. And then you set the break-even point for the trade. by the expiration. What do you have here? You have, let me move this one down a little bit. Okay, here you go. You have what? You have 65% chance of winning as a seller, right? This is a break-even point. Stop price is right here, right now. Zero line. Anything above zero line is a profit. So stock price can go up, but not beyond 192.75, because if it goes beyond that, you'll be losing money. Stays below that, you'll be profitable. The max profit is where it stays at 185 here, the current stock price, or below. That's where you get $775 profit. All right, so that is the profile of the trade. And you have 65% chance of winning. So again, as a seller of option, you have a better chance of winning. Now, even better, time works in your favor if you are the seller. How much time will decay per day and in your benefit? So in this case, you are the seller, so you see the theta, time decay, is a positive value. Positive value means it works in your favor. Unlike when you sell option, you see negative numbers, right? So that means time works against you. Now, as a seller of the option, time works in your favor. Every single day, you clock in $14.7, and this one will accelerate towards the expiration time. So let me simulate that for you. So you see, if I simulate time passing here, you see the theta will accelerate, right? So that's the benefit of the seller of option. Time is your friend. Time is in your side. You will have a friend working for you even when you are sleeping. So that's why selling options have a better chance of winning. But watch out. Watch out. In this case, if the share price goes up a lot, you'll be losing a lot. And potentially you will lose unlimited amount of money, right? You will lose unlimited amount of money because you don't own any shares. So let's say if the share price goes to 500, you have to go to the market to buy shares at 500 and deliver to the buyer of the option at 185. So think about it. Of course, a theoretical scenario, but you have unlimited upside risks. So there's a pros and cons for selling option as well. So in this case, let me summarize it here. The pro is time decay works in your favor. Times is your friend, and you have a good winning probability of winning, 65% in this case. The disadvantages are, number one, the premium you collect is your max profit. That's it. You cannot make more than that. It's the same concept of selling insurance premium. And if you don't own shares and you sell single call option, you will expose to unlimited risk when the price surges. Yeah, and that for me, it's a dangerous game and it's a no-no. You don't do it. Selling naked call option without owning any shares is a dangerous game. All right. So that is my part 2 of the lesson today. So then you by now you could be scratching your head and say, hey, Bang, earlier you told us that buying option is a losing game. And now you're telling us that selling naked call option is a dangerous game. So what do we do? So should we be a buyer? Should we be a seller or what? Right? So you could be a little bit confused by now. That's why I say I don't do the number one, buy a single call. I don't do this one either, the sell single call without shares. But what I do is this. What I do is 1 and 2 combine. You do both 1 and 2 combine, that will form a calendar spread, or in the short form I call CS. and I will explain to you why CS or calendar spread is the best of the two, right? The much better of one or two, right? So you have something like completely change your game. Something magic happen if you combine a losing game with a dangerous game, right? So the bad thing, when you combine the bad thing with the worst thing, you have something really good. That's something so magic that I could not even understand. But let me explain to you, all right? Before I move on to the part three of my lesson, any burning question? Okay, live now you say selling part naked, meaning you only own 50% of the share. Too dangerous or okay? I think it's still dangerous. You still have unlimited upside risks. Okay, Sunny, you seem to be rushing me now towards the Canada spread because you are in the US time zone. Understand that. All right, so let me, so far so good. Good. Okay, let me move on. Otherwise, some folks will be very late. Now, I say don't do one, don't do two, but do one plus two combined. So if you do one and two combined, what does it mean? You will do a combination of buying a long dated call option and selling a short dated call option at the same strike price. And you do it both at the same time, right? So the trade will be like this. The trade will have two legs. Leg number one, you buy 185 strike call option expiring in January 2026, and you pay $17.78, which we know, right? That's leg number one. But you don't just buy that and leave it there and hope that the stock price will go up. To finance part of the cost of that option, now you sell another call option, same strike price with the shorter DTE, only 28 days, which is 4 weeks, and you collect 7.75 premium. And you know, by doing it, it cut down your cost of the trade almost by 40%. So instead of paying 17.78, now you pay only $10, right? 10.03. So for the whole trade, it is now costing you $1,000, not 1,700, right? So by selling the short dated option, it cut your costs down. And the beauty of this is not just cutting the cost down, it cut your risk down also. The max risk on the trade is now down to $1,000. You cannot lose more than this, even if the stock price goes to zero, even if the stock price goes to 1,000. Doesn't matter. Your max risk in the trade is now capped and reduced at $1,000 per contract. This is a concept of lease to rent. Now, the cover con is like you buy a property and then you rent it out, you collect the monthly rent, right? But you know, buy a property will cost you millions of dollars. So it's very expensive. For you to do a cover call strategy, you need to have a large capital. Now, what if you don't have that large capital? Well, can you do that business? Yes, you still can. And that the concept of lease to rent, meaning you instead of buying a property, you just rent that property for let's say 6 months, and you rent it out on a monthly basis. Let's say 6 months you rent it for let's say $6,000, right? So you get a deal with the landlord to rent a property for 6 months, and you pay $6,000 for that 6 months. Now, against that one, you don't leave the property empty. You find a tenant, right? Every month you rent it out to a tenant. You collect $2,000 a month. Yeah, $2,000 a month. And if you can find three tenants in 3 months, you got 6,000 already, right? So the remaining 3 months will be for free. So that is the concept of calendar spread. Yeah, so you buy a long dated option there as a proxy, as a stock holding. Against that, you sell short dated option to collect shorter term rentals or rents or premium to pay off the long term lease. And after a few rounds of renting, you'll be owning the remaining long option for free. That is the concept of calendar spread here. Imagine you sell 1 month here, you collect 7.7, right? This is just 1 month. What if next month you collect another 7.7? So then you cut your cost down to only $300. Yeah. So then you almost get the remaining time for free. So that is a concept of calendar spread, the concept of lease to rent. And you reduce your risk significantly. You cannot lose more than $1,000 here. You cannot, no matter where the stock price goes. If it stays here, doesn't go anywhere, this is the best. Because if the stock price stays exactly where you enter the trade, 185 here, by the expiry date, you will earn a lot of profit. Yeah, and let me get into it. Now, advantages of doing this is, first, it reduces your capital and reduce your risk, right? So it optimizes your capital. So when you use less capital like this, $1,000 per contract, and you could earn significant amount of profit. In this case, max profit is about $600, 60%. 60% return on investment in 1 month, in 23 days, right? So that is the concept of using less capital to boost your return on investment. And I show you my account, I consistently outperform the S&P 500 for the same concept. Now, you cap the downside risk, because if the stock price collapses, I mean, you're wrong in this case, guess what? You cannot lose more than what you paid here. Meaning the house that you lease for 6 months, the worst case scenario is you cannot find any tenants, right? Then you have to let it empty for 6 months. Then $6,000 is your loss. You cannot lose more than that. That is a concept of lease to rent, compared to buying that property for $1 million and then you could not find any tenants and you could not move your home there because it's too far away, and you just waste your money there, right? So obviously, lease to rent is a better business. Yeah. Best thing is time decay works in your favor. Yeah. So let me show you this one in the profile here. Now I show you two trade, right? One, buy a call option and pay, I think I say I pay 778. How much is it? I pay for the call option 1778. So that is the mark price, 1778. Right? So that is buying a long call option. We talk about it. Second leg, I will sell a short dated option and collecting $775. That form the calendar spread. And this is a big picture of the calendar spread. You see, calendar spread will make the most money when the stock price stays right at the strike price, 185 here, by the expiration of the short call. That's where you make the most money. Now, in case you are wrong, the stock price collapses, guess what? You will be losing maximum amount of what you paid, which is a net of the two here, $1,000. You cannot lose more than that. In case the stock price goes to the roof, you cannot lose more than $1,000 as well. So that is the risk profile of the trade. Now, if you zoom this trade into nearer to the profit zone, you will see how many, what is the probability of your trade making money here, right? So if I set slices to the break-even point on the date after the expiration of the short call, what do I have? So I need to move this one to August 16, correct? And today is July 20th. So I have about 54% chance of winning. Yeah. At the entry, I have 54% chance of being profitable. So anything between here, 173 and 202.7. That is my break-even point. So within that range is my profit zone. And 54% chance that the stock price will stay within this range in the next 23 days. So I have a good chance of winning in this trade. I could make less money if the supply drops to here, or I could make less money if the stock price moves up too much, and I make more money if the stock price stays around the 185 area. So the best is the stock price goes nowhere, right? Can be up, can be down, but by the time it expires, it goes back down to around 185. That is the best profit zone. Yeah. What if I'm wrong? And you know, I cannot lose more than $1,000. Yeah. So that is the profile of the trade. Now, when you execute this trade, you don't execute leg by leg like this. You don't enter one and then enter another two, but you execute both legs at the same time. How? All right, go back here to the platform, and it's the same for interactive brokers as well. You open up these two DTEs, right? Two series. You buy 185 here. You click on the ask and then hold the control key here. And then you sell 185 on the August 15. And it shows you that this is a calendar spread. And it shows you the net debit for the trade, which is $1,000. Yeah. And then right click, you have the same thing, right? You don't have to click into two legs anymore. You just click on one trade. And this is how to execute the trade. Both legs enter at the same time. And you can control the max risk in this case. So you don't have to deal with the slippage of the price between the two time of entering. In this case, you enter the trade at one shot. And this is a trade. Right? So if you do both at the same time, like I just demonstrated. Sorry, let me move to that slide 1 and 2 here. So if you execute both legs at the same time, what happened? You will have reduced cost and reduced max risk. But the best thing here is you have time works in your favor. Time decay works in your favor. Let me show you that. So at this trade, and if the price stays here, if the price stays at the current stock price, which is 185, what is the 185 here, right? If the price stays at 185, the time decay is $9 a day. So every day passes, you get $9, regardless weekend or weekday, doesn't matter. And again, $9 here doesn't stay constant. It will accelerate towards the expiry date. So we see at the entry, the pink curve here, you make no money, right? Pink curve here shows zero money. But as I simulate the time passing, you see the pink curve rises towards the blue curve, the blue curve. Yeah, see if I simulate the time passing here, you see the time decay will accelerate and also the profit will be generated. Yeah, time decay go to 11 now, 12 now, 13 now, 14 now, 15 now, 16 now, right? So the closer to the expiry date, the time decay benefit will bring even more to the trade. And the profit will rise towards the max profit. And the max profit, if you are lucky, the stock price stays around here by expiry date, the max profit is about $600. $600 divided by $1,000 capital, guess what? 60% return on investment if you're lucky. Of course, this is hard to get. Sometimes you get half of that, sometimes you get 20% of that. It's still okay. If you get half of that, it's still 30%. If you get 20%, that would still be, so let's say if you get 25% of the max profit, 1/4, that is still 150, right? 150 is still 15%, right? 15% over 1 month. That's very good. 15% a month, still good, right? So I don't count, I don't expect to make the max profit because it's difficult. Most of the time, I will make something around here and have very wide zone to make that kinds of money. So I could make like $200 after a month. $200 a month means 20% a month. That's still very good. 20% a month. Very good. Right? And the good thing is you don't have to have a big account to do it. You have like few $1,000s account and then you enter one trade like this, you use only $1,000. And that's your max loss, by the way. Right? So People say option is risky. It's not. It's very safe. You know exactly how much you can lose. And I don't even let it like lose $1,000. I will cut loss at 50% of that. So if the stock price drops so much down here, and I lose $500, I will cut losses right here. So my stop loss is at $500, right? So then in the unlikely scenario, when the stock price collapses a lot, I will cut loss at $500. That's my exit rule. 50% negative, 50% return on investment. So that's okay for a small account, right? I tell you, calendar spread is one of the strategies that uses the least capital, and generated the most return on investment because of low capital uses. And I think it's very powerful. I think this is something that I use a lot. Now, I will talk about the concept of rolling after this, but just finish this slide and then I will continue with that thought. So the advantage continue to be the timing side. So time works in my favor. Why? Because the short dated option will decay faster than the long dated option that I'm holding. Right? So net, I still have a benefit of time decay. Right? Because the short dated option will decay very fast and it accelerating very fast. Well, the long option will have like 6 months to go. So it decays slower. So every day I wake up, I will get some benefit from the time decay in this kinds of trade. And this is a high probability winning rate, winning game for me. So don't do number one because that is a losing game. Don't do number two because it's a dangerous game. But do the number three, which is one and two combined, because that's a high probability winning game. And that's what I've been doing on the time. And for those of you who've been watching me trading, you know this is one of my favorite because low capital, high return on investment, time works in my favor. And I can also potentially convert the trade into a bullish trade when the supply goes higher, which I will talk a little bit later. Now, disadvantage, of course, is uh, the profit, max profit is capped. It's not like you have unlimited profit. No, in this case, you have limited profit and it capped at the max profit there. And it will require some sort of rolling. So if the stock price moves up a lot, then I will roll. So when I roll the short gone up from 185 to 190 to 95, for example, I will essentially convert the trade into a diagonal spread, which have the P&L curve like this. So in this case, if I roll the shotgun up, then I will eliminate the loss zone here in the calendar spread. This loss zone will be eliminated, and I will have no more loss if the supply goes higher. And my trade will become a diagonal spread, which I have explained, I think, in my black market last year and the mid-year event last year. I also talked about the diagonal spread. Somebody called it poor man's overcall. Same thing, right? So if I convert my trade into a diagonal spread, that means I will convert my trade into a bullish trade to ride on the uptrend of the stock price. So for me, Google price right now is undervalued, right? I believe in the long term, Google price will catch up with the intrinsic value. Based on my stock oracle, it's 203, right? So still have like 18 points to go from here. So when it starts to catch up with the intrinsic value of the stock valuation, I will convert my trade into a diagonal spread, which open up more headroom for the upside. And then in that case, it's just a matter of how much profit I make in the trade. I don't have to worry about the loss zone in the upside anymore. Got it, everyone? Now I will explain step by step how to construct a calendar spread, right? Okay, so calendar spread is very dynamic strategy. You can be used for a neutral trade, can be used for a bullish trade, can be used as a bearish trade as well. It can be used for playing earnings, can be used for playing with some events. But in most cases, I use this as a as a neutral trade, right? And it involves two legs. Legs number one, I buy a long dated call option, long DTE, at or near at the money, right at the money. Yeah, like Google at 185, I buy at 185. Leg number two, I sell a shorter DTE call option at the same strike price, which is also at the money, 185. And that will reduce my max loss or capital in the trade significantly. I cut the cost down by 40%. Remember that? And the trade could have very high potential, return on investment potential. 50% to 150%. So the trade I showed you earlier has 60% max return on investment. How could I get 150? Well, with rolling and you open up the higher profit zone on the upside when the stock price goes higher, you could potentially goes much higher than 50%. Yeah, with the rolling. And before you roll, right? Ideally, when you construct the trade, the probability of winning here, at least you need to have 40%. Ideally 50% or beyond, right? But with rolling, you can have like 70% win rate, right? If you roll. Yeah. All right. So optimal entry rules if you enter the trade here. And again, on Wednesday, when I have a live trade hunt, I will explain this again, but just let you know the complete lesson here. Not even complete. In the curriculum, we explain even more. This is one part of it. So I use this calendar spread on stocks with high liquidity, good option liquidity, right? I do not care much on the fundamentals of the stock, to be honest, for the trading here. So high option liquidity means you look at the option chain, you have to see the weekly options. Any stocks that have no weekly option, don't touch it. For example, one stock has no weekly option like this, I won't touch it. Like FICO, right? FICO. So this one has no weekly option. I don't touch it. So because this candle spread requires a lot of rolling and liquidity need to be high. If the stock has no weekly option here, that indicates that the stock has low liquidity. Yeah, so don't touch those. Only trade the one that have weekly options. And the bid and the ask price in the particular option need to be close enough, right? Look at the money bid and ask. It should be tight enough, like less than 0.4% of the stock price. That would be ideal. So if the stock price is $100, bid and ask should not be more than 40 cents. Yeah. Technical setup for this trade, I need to see the stock price at least forming a consolidation and ready to rally. I don't want to enter a trade when the stock price still showing a secular declining. That will be a suicide model pattern, right? Don't touch one. So let me just show you one and you tell me, is it a good candidate for calendar spread or not, right? Just give you a flavor of the technical setup that I'm looking at. Let me see. So I think this one, Novo Nordisk, NVO. Is it a good candidate for calendar spread from the setup standpoint? Yes or no? No, right? Many of you already catch it. It's on the declining trend. Obviously, it's on the declining, and there's no sign of bottoming. There was time when we thought that it already reversed to the uptrend, but no, it failed again. So it's forming lower highs, obviously, right? Lower highs, right? And then lower lows, right? So lower low, and we may see lower lows again. Tell me this stock is a good candidate for calendar spread or not from the technical standpoint. Celsius Holding. Yes or no? Yes, many of you got it right. So for me, I like this setup because the reversal has been established, right? Very clear, higher high, higher lows. So obviously it's on the uptrend, right? So you got the idea. You got the idea. So sometimes it's so obvious that you just use your bare eyes to spot it. Yeah. So it's not like rocket science kind of thing. It just based on your it's visible chart that you can see there. All right. So let me go back there. So I like to see a setup that at least it shows the stock price stop declining, consolidating, and ready to bounce. Right, ready to go higher. In terms of DTE, for the long con, I would choose anywhere between 3 months to 6 months. Short con, ideally 2 weeks to 4 weeks. Yeah, so that is the entry. And then strike price, I prefer to choose near at the money or at the money. And then short con, the same, near at the money. Max risk will be equal to the net debit that you pay for the trade entry. And that is also your capital. So your broker should not block more than that. And I think you need to have a margin account to have it. Return on investment before rolling, at least you need to look for 25%. So in the case of Google, 60% because it's crossing earnings. So that's why it has a higher return on investment than usual. But in a normal time, not crossing earnings, you need to look for at least 25% for the return on investment before rolling. But of course, after rollings, you have much higher return on investment. You would have a decent profit zone, ideally with 50% or more probability of winning before rolling. So here how to construct the trade. This is what I demonstrated earlier. Let me just summarize it. Same using the same Google stock, right? Stock price at 185.06 here. You will buy two legs. Leg number one, you buy call option at or near at the money, expiring 3 to 6 months. So in this case, I choose January 2026, which is about 6 months. Yeah. I buy at 185 strike, which is near at the money. But sub price at 185 as well. Yeah. And I pay 17.78 premium for the trade, which is the mark price here. Yeah, mark price. Leg number two, I will sell a shorter DT expiring within 2 to 4 weeks. In this case, I think I got it wrong. I sell August 15. I sell August 15, which is this one. So I sell August 15, which is about 4 weeks. Yeah, 4 weeks here and collecting $7.75. So cut the cost by 40%. So net, I paid $10 as an entry debit, which is also my max loss or also my capital, $1,000. And that's how you construct the trade. And you see the broker will block you the same amount of the max loss. That's the cost of the trade, right? Or buying power, the same thing. Yeah, that's simple as that. Just two legs. Buy, sell, same strike price, different time frame, right? And then keep rolling the short call. Risk reward profile, which is what I shown you as well. The trade has two loss zones. Loss zone on the left if the stock price drops a lot. Loss zone on the upside if the stock price rallies a lot. And then in between will be a profit zone. The stock price somewhere in the middle of that. The max profit is somewhere in the middle of that. And you have something like 50% plus return on investment before rolling. Break-even point is quite far from the current stock price. So you have some margin for errors. Yeah. And you pay a net debit of $1,000 there. Yeah. So if you are lucky, the stock price stays exactly at 185, you get $600 profit, right? By the expiration of the short call. And that translates into almost like 60% return on investment before even rolling. Now, how to exit the trade? Well, in this kinds of trade, you expect to roll the shotgun for many rounds. Roll it when the shotgun, if the stock price stays low, right? Keep rolling the shotgun to the same 185, collecting more premium. But if the stock price rallies a lot, well, you just roll the shotgun up from 185 maybe to 190, 195. Sometimes you pay a debit, sometimes you collect a credit. Depends on how much the stock price has rallied. And if you roll the shotgun up and you keep the long gun at 185, that effectively means you convert your trade from a calendar spread into a diagonal spread. Yeah. And that is a bullish trade. And you no longer have the loss zone on the upside when you convert it into diagonal spread. And then after a while, you keep rolling the shotgun, and if it hits your profit target, and normally my profit target will be between 50 to 150, depends on the stock. Some speculative stocks I go for a higher return on investment. Like one stock I showed you earlier on later on the GameStop. But for the normal stock, I would target 50%, right? And then if it hits 50%, I would consider closing the trade. Cut loss if the stock price drops sharply, right, at 50%. So this trade has a max loss of $1,000. So when it hits about $500, if the stock price drops below like 155, then I will consider cutting loss on the trade. So in this case, I will not lose $1,000. I lose only $500, right? So you need to manage the trade. Now, key benefit for calendar spread, you can optimize your capital, and therefore it is totally suitable for traders with small accounts, right? So you don't need to use a large capital anymore. Imagine if you buy 100 shares of Google, how much you need to buy 100 shares if you use cash to buy? Well, you need $18,500. This trade you use only $1,000. 1,000 versus $18,000 is like what, 6%? You use only 6% of capital comparing to buying shares. Yeah. And because of that, if you generate good profit, right, it would translate into a very good return on investment, even if the stock price doesn't go anywhere. That's the best thing. Stock price doesn't go anywhere. Actually, it's the best thing, because that's where you get the max profit. And the trade will also reduce your max risk significantly. Even if it gaps down a lot, you won't lose more than the capital you pay, which is $1,000. If you use stocks to trade, if it gaps down, your stop loss doesn't help. You could lose thousands of dollars if the stock price gaps, like on earnings. If it drops like $30 on earnings, for example, you could lose a lot if you use stops. Yeah. So the stop loss doesn't help. But if you use this trade, well, max loss is $1,000. And if you manage, you can cut loss at half of that. Yeah. Much better way to trade. Yeah. You can minimize the risk in case stock collapses, like I just said. And then you have a decent profit zone with high probability of winning. So 50% or more. And then if the stock price starts to rally, you can always convert your trade into a bullish trade, which is diagonal spread, to ride on the uptrend. So I believe eventually Google share price will play catch up, because lots of Max 7 stock has already gone to new all-time high. We're talking, Nvidia, we're talking Meta, we're talking Microsoft. This is one of the mega cap stock that has not participated too much together with Apple, right? So then, therefore, and it is undervalued, right? Eventually, it will catch up. And in that scenario, you could ride uptrend by converting your trade into a diagonal spread. Yeah. And the best thing is, it could take the stock a long time to rally, and you're completely fine with that, right? You are paid to wait. Time decay works in your favor. So I don't mind if my stock takes 3 months to rally. Doesn't matter. I keep collecting premium time decay works for me every day, so I don't mind. The stock price can just sleepy as long as it wants, and I still can make good money from the trade. Calendar spread is a highly versatile strategy. It can be used to construct bullish, bearish, or neutral trade. Most of the time, I use it as a neutral trade, but in the lesson, we will show you how to use it as a bullish trade as well, or bearish trade as well. Yeah. And this is something interesting. You can use this one to trade speculative stocks, right? So obviously, yesterday you heard from Adam on investment. You don't touch speculative stocks, right? Thing like Tesla, something like nuclear stocks, something like maybe quantum stocks, something like Bitcoin ETFs. You don't invest in those unless you have very strong conviction. I know thousands have a strong conviction on Tesla, so that's a separate, different story. But I tell you that trading, you don't care. You can use calendar spread on speculative trades. And I tell you, the more speculative the stocks are, the better premium you can collect. And it's a very interesting strategies to use. In fact, those of you who see my trade, right, I use it on speculative stocks as well, even on Bitcoin ETF, the leverage Bitcoin ETF. I also use calendar spread, and also recently I use it on stablecoin stocks. I use it on very speculative nuclear and quantum stock as well, right? I don't mind because the risk is very low. The risk is very low, and the premium you can collect is very good, right? So speculative stock mean the option premium is elevated, very high. You just need to run it one or twice, and you get the rest for free already. Yeah, so it's a good strategy to trade speculative stocks as well. Again, so investment is a different thing. Trading, this one you can use on speculative stocks because the risk is much smaller. What are the disadvantages? Again, you cannot make unlimited profit. So in these strategies, the upside profit is capped, and that's a max profit there. It's like selling insurance. You cannot make unlimited profit. And then the trade has two loss zones, right? If the stock price goes up a lot, you'll be losing money. If it falls a lot, you'll be losing money also. You need some effort to roll the short call to manage the trade, cut loss at 50%. So requires some efforts, not like a trade that you buy and then you forget. Yeah, don't buy and forget in this one. In summary, calendar spread, which has another name called time spread or another name called horizontal spread. So different names, but most of the time people call it calendar spread. It's a neutral strategy, or the one I use it, but it can be used for other purpose as well. I use it as a neutral strategy with essentially, so I need to delete this one. This is wrong. This is wrong. This is wrong. Sometimes I make mistake as well. All right, so it's a neutral strategy. It has a risk on the upside. So unlike diagonal spread, you have no risk on the upside. This one you have risk on the upside. My preferred version of calendar spread is this: buy a call option expiring in 3 to 6 months and the strike price is near at the money or at the money, and sell a call option at the same strike price expiring and at the shorter DT, 2 to 4 weeks. Yeah, and that will form a calendar spread, and then you will roll the short call to collect more premium or to create more headroom when the stock price goes higher. You will take profit at anywhere between 50 to 150% return on investment, and you cut loss when you lose 50% return on investment. And the chart looks like this with the stop loss on the left hand side. Okay, now let me zoom into one real example of one trade that I use calendar spread for, and this is on GameStop. And you know GameStop is one of the speculative trades, right? It's one of the one of the speculative stocks, right? So GameStop, there was time when it went on the way to 100 plus and then went down. And then last year, 2024, by end of May, suddenly what is that? The kitty guy, the guy behind the rally of the GameStop, suddenly reappear, and then it boosts the stock price from somewhere like $10 on the way to $65 in a matter of few days. And then after that, it died down, right? It died out. It went down to about $18. And because of this volatility, the option premium was so high at that point in time. And that just create the opportunity for a good calendar spread from the risk reward profile. When you have the short dated option premium so high, you just need to run the trade a few rounds and then you could be profitable already. Yeah. So in this case, the stock price went down, but because of the volatility, the premium of the short dated option stays very, very high. So I enter the trade by end of May 2024 there, when the stock price was at about 18. And I enter calendar spread 1818. So the details here, but I don't know, you can see it a little bit small. So I bought October 18 call, and I sold July or June 7, 18 call. So it's calendar spread. And I pay a net debit of $3.40. That's the net debit, the entry. So $3.40 times 500. So my maximum loss or capital I paid is $1,700. So 3.4 times 5. So that is $1,700. That is my max loss. So that's my capital for the trade. So no matter where the stock price goes, I cannot lose more than $1,700. Now, in my case, after I enter a calendar spread, my expectation was that the stock price will like die down, right? Consolidate, and then maybe you can go higher. But in my case, I was not that lucky. So right after I entered the trade, the stock price went all the way to 24. To 24, right here. So it jumped one day after I entered the trade. The stock price jumped to 24. From 18 to 24, it jumped like what? $6. From here to here, it jumped $6. Wow. So imagine the calendar spread have two loss zones. If it jumps too much, it will be falling into a loss zone in the upside. Right. So then I quickly roll my short call from 18 here. I roll my short call from 18 to 24, right near at the money. So I roll it here, right? So I roll it to 24, and I pay a debit of 1.1. So 5 contracts, I pay like $550 for the rolling. So when rolling a short call, sometimes you roll for a debit, sometimes you roll for a credit. Debit means you convert your trade into a diagonal spread and you have no risk on the upside, right? So it's like you upgrade your apartment from 2 bedrooms to 3 bedrooms. You have to top up some money, but you expect to rent it out for a better price, right? So it's okay. Upgrade your apartment. And it's okay if you think the property price will continue to go higher. And I don't mind to top up some cash to upgrade my apartment to get a better value, because if the property price goes higher, I will make more money. So that's the expectation. So I run it up for 1.1 debit, so I pay more. Stock price then consolidate a little bit, but then it went even further after that. I think 2 weeks later, it went on the way to $30. From here to here, $30. I have to roll. I roll one more. In this case, I don't roll all the way to 30 because I think there may be some pullback, right? So to be conservative, I still upgrade my 2 bedroom to 3, but 3 now to 4. Instead of upgrading to a penthouse, I upgrade to 4 bedrooms. So a little bit like one foot in, 1 foot out. So still rolling up, creating more headroom, but not too much. I don't want to pay a big debit. So in this case, I roll my 24 to 25. So you see here, I roll my 24 call to 25. And for this rolling, I pay zero debit. So in this case, I changed my 3 bedroom to a 4 bedroom for zero additional cost. It's a good thing. Sometimes you get a good deal, just roll it up like this. And then the stock price kind of stabilizing, going nowhere, dipping a little bit down, which is good because my short call is at 25 and a half and stock price dropping towards 25 and a half or 26, which is good. Then the next round, I roll my shotgun further to 27, right? From 25.5, I roll it up to 27. In this case, I roll it up and I get paid for the rolling. So I upgrade my apartment to a landed house and I get paid for it because the property market is good or something, right? Because the premium is so good, the short dated option for this speculative stock is so good that even when I roll it up, I get paid for the rolling, right? So sometimes I have to pay debit if I roll a lot, but if I roll only like 2 or 3 points, I could be paid for the rolling as well. So in this case, I got paid 68 cents debit credit for the rolling. After that, I roll my call from 27 to 28 to create even more headroom. And for this round, I get even better premium. So I get paid 70 cents credit for the rolling. So it's a very interesting situation, right? I continue to expand my profit zone and I'm paid to do it. Right? That's the good thing about calendar spread. You keep collecting premium when you roll, right? And and then all the way up, and then I roll it down as well. So the make the long story short, I keep collecting premium every time I roll. I roll. This time I pay a little debit, but most of the time I collected more premium when I roll. Eventually, in September 6th here, I closed the trade for $4.8 credit. So I sold it at 4.8 credit. So the P&L works like this. I paid for 3.4. I paid extra 1.1. After that, I keep collecting credit, which reduced my cost. And eventually, I sold my position at a higher price. And I made about $1,900 profit. And that translates into 112% return on investment in a matter of 3.5 months, less than 3.5 months. And if you look at the whole journey, right, the subprices did not go a lot from 18 here, maybe at the time of the closing, it goes to 21. So it went up like $3 for the whole 3 months, 3.5 months. But it's very volatile in between. So the key point here is you keep managing your trade, rolling up, rolling down, playing along with the price and collecting premium to reduce the risk, reduce your cost further, and eventually translating into a good profit for the trade. So this is one example of how you can use calendar spread to trade speculative stocks, right? And make a very good money out of it. And you don't risk a lot. You don't risk a lot. Yeah. So occasionally you will see some speculative stocks like this. You can totally can use candle spread to play along. It's very interesting. All right. Let's move on. Before I get into further, just a bit on the testimonial from some of our students. So Wendy sent it to Adam and myself here. Say, my portfolio grew 59.38%. Joining the course is really a bless for me, right? People bought into the course and they're very happy. Surens keep collecting premium from selling cash secure put, and he has been very unselfishly share the result almost every month, right? So like he say he collected $6,700 premium in March, first quarter after he bought the course. Isa say I also purchased option courses and started trading options in April 2023. I joined OTP Group, and this was my best decision as and the booster for my account, right? So ISA get 121%. Beautiful. Suren again updated his scorecard almost every month. So this November 23, he got $10,000 premium. Jason used option um, to trade in the during the time that the market went through the bear market. That's in 2022. So he said that his long-term portfolio lost to 2K, but he made more than 10K in option trading today. Yeah. Michael also used option to hedge his portfolio. I'm not worried about market falling when I'm sleeping, right? My account is about saying the same because of hedging. So during that bear market, Michael has used put option to protect his investment. Hannah keep collecting money, profit every week. I have profit every. It's too good to be true. All right. So now what Adam explained in the morning and myself I explained just now on the options, just a flavor. It's just a flavor of what option can do for you, right? What we talk is just maybe 3% of what we actually teach in the course itself. And recently, I mean, in the previous few years, we introduced a course and it's like pre-recorded videos, and then people learn from it at their pace and that at their time. Some people are okay with that. Some people feel that they need a little bit more hand holding, and therefore the team got the feedback and they crafted a option Wave Rider mentorship program that could help you get on board faster and do a little bit hand holding almost every month or many weeks as well to get you to the journey and help you make profit as fast as you can, right? So this option Wave Rider membership is an income boosting program for both traders and investor, right? Now the whole package have two levels. Level one called option iron shell, and level two is called iron striker, right? So the level one is more basic and for new starter, and the number two is more advanced trader. Yeah. So level one, it includes the option basics. So even if you know nothing about option, right? You don't worry. You start from the scratch. We teach you from the ground up, right? What is options all about? What's a call option, put option, buy, sell, uh, and then Greeks and volatilities, so all those basic things, which is very foundational, very important for you to go through. Now, the first 7 years of my trading option, I did not even learn the basic thing. So I lost money most of the time because I did not know, hey, I bought a call option before earnings. The stock price went up, but why do I still lose money, right? I did not know that the volatility crashes after earnings, right? Things like that you will learn from the option basics, right? And then we also teach you some setting up the charts, the tool, the platform, understand completely the call and puts option and when to use what. Yeah. For investor, obviously you can use option to get extra income from selling cover call on the stocks you already holding. And for those stocks that you want to buy but you want to play hard to get, you can use cash secure put, the one that Adam explained this morning. Yeah. And then for uh, traders with small accounts, you can trade directional trades. If you are bullish, you can use boon con spread. If you are bearish, you can use bear put spread with low max risk and low capital. If you want to have a higher probability trade, then there are two other strategies you can use. Boon put spread, which typically have 70% chance of winning. And similarly for bear con spread, you have 65 to 70% chance of winning. So higher probability of winning. Yeah. And then we will talk on the technical analysis, how to spot the chart, how to identify some of the patterns. We have bonuses lessons there, especially on option assignments. Lots of you send in questions on, and I mean, people are very worried about what if I get assigned, how to deal with it. I tell you, I have the full set of videos on option assignment, and once you watch it, you will never have to worry about option assignment anymore. Guarantee. Option assignment is something you should be happy, not to be worried. All right. And then a summary of what and when to use what option strategy. We have other bonus strategies like cash flow wheel. I know some of students are using as well, and then using put option to hedge the downside. Yeah. Now, level two obviously includes a lot more advanced option strategies. The one that with the TM here is our own trademark, proprietary strategies that we created. So Adam created the Boot Bootstrap Extreme. I created the rest, right? So Trade Lizard, Adam used it a lot. Crouching Boon, I use it a lot. Boon Bootstrap Extreme, Adam also use it. Diagonal spread is one of my favorite. Boonbang color also my favorite, and DS hammers my favorite. So this bucket is my bread and butter together with the calendar spread. Yeah. And then for neutral strategy and condor, calendar spread and snipex, the one I invented. So again, calendar spread is in here, but I use it a lot because the dynamic of the strategy, right? I can always convert the calendar spread into a DS hammer or diagonal spread, right? To make it like bullish trade. So that's the dynamic of the trade there. One of my favorite. All right. Now, if you are very aggressive on one direction for the stock, you can use synthetic, right? This morning, Adam talked about bullish synthetic, where you buy a call, you sell a put, that is equal to buying shares, right? So you long shares, that's how you get. But you use a fraction of the capital, not the max risk. Max risk is the same, but the capital is just a quarter, sometimes a fifth of the capital you use for stock trading. And Boonbang, the one I created with unlimited upside potential. And when I'm really bullish, I use this one as well. Right. For those who have signed up, I think tomorrow I have a skill revision where I will talk about this strategy. And we talk about skill reason later to avoid confusion here. And then for situational event like playing earnings, we do have other strategies for you to use to play earnings. It's not buying a call, buy a put like I used to do, where I lost money most of the time. We have a proper strategy with limits the risk and have a good return on investment as well. So those are the strategies that we created. Especially the second one. And very importantly, when you manage a portfolio of trades, right, it's all about managing your money and managing your risks. The psychology part is very crucial. It's easy to said than done when you say, okay, I have a profit target and I have a stop loss for my trade, and you say to yourself that you will stick to it. The matter of fact is, it's very difficult to do it, right? And it comes when we have to cut loss on the trade. How to stay disciplined to cut loss. Equally difficult is how to take profit. It sounds very weird, but it's true. Sometimes I find taking profit is more even difficult than taking a loss, because you always have the urge to be more greedy, to go for a higher profit, and then boom, the market just in one day it can completely wipe out your profit because of something like somebody sent out in a truth social and things like that, right? So you need to be disciplined especially in the current environment when things can move upside down in a matter of few minutes. Some minute people say, okay, Joe Powell will be fired. A few minutes later, we say, no, 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 it's not going to happen. So things like that, right? You need to deal with this reality right now. And how to design a portfolio of option trades that can help you generate profitable returns over the long term, the one that you can set you for financial freedom, right? So the amount of money you can generate that could potentially help you do what you love, right? What I did for myself, right? So the profit I generated from my option trade is more than enough for my family, right? I'm a very simple guy. My family is a very humble family. We are not spending a lot. So the amount of profit we get from trading alone is more than enough for us. Not to mention we have, REITs, we have property as well. But the point is, I'm not bragging. I just want to share so that hopefully I could inspire many of you out here who still having, full-time work. I mean, I'm not advocating for you to quit job or something. No, I'm not doing it. I used to be in that camp, and I love my job, to be honest with you. It's just a matter of time, right? When you get older, you could not deal with the pressure from the work, then you need to think of something else for yourself. And this is something I think is perfect for me, right? So when I say I retire, it doesn't mean that I will shut down and then go travel the world. I'm not doing it because that will do more damage than good for my brain, right? My brain will shut down if I do nothing. So I want to keep myself busy with trading, with teaching and coaching. That's also helped me keep learning as well. Yeah. So, but I do what I love, and that's the best thing when you are paid to do what you love. Yeah. Part number six, you could also learn some technique of the option rolling. It's very important because calendar spread is one of them where you need to roll. So you need to uh, understand when to roll, what strike price you want to roll to, and what DTE, time to expiration, you want to select for the new options. So those are the thing that I teach on the videos there, and to me, it's a combination of both arts and science, right? So it's not like purely science, rocket science, not. It's some guessing, some judging, some sensing, together with some math on the Greeks, on scientific side of the trade as well. So it's a combination of art and science. Yeah. Number seven, we will cover how to use different brokers, right? Taxi trade, interactive brokers, and of course, lots of lessons are done on the TOS, Think or Swim. And recently, I added one session on how to enhance your cash, the one that you're parking in your account, via buying USD bills. USD bills today can pay you a decent amount of return, right? So if you think the market is on time high and you wait for a pullback to jump in, if you park your cash in Think or Swim, for example, they pay you almost nothing. If you park your cash in your IBKR, they can pay you up to like 3.8%. If your balance is more than $100,000, less than that, they pay you less, right? So the best thing could be still, park your cash in USD bills. No matter how big or small you buy, you get 4.2, 4.3%, which is better one. And if you really need the cash to buy shares when it pulls back, you can always sell your bill and then jump in. So that's the thing I explained in the bonus um, lesson here. And then we have the back ratio, and then you have collars. Those are the two strategies in the bonus side as well. Now, this morning, Adam also talked about this one, right? Lots of people wrote to us, and for the first time they trade option, they are very fearful. They say, "What if I'm a newbie? What if I fail? Option is too complex for me. So many things I need to remember. I'm a slow learner. I am afraid to start. What if I make a wrong trade?" I tell you, these are a very valid concern. We too, Adam, myself, we used to have the same concerns when we started, but as always, when you start something new, learn new skills, everything is complex. Even when you learn how to swim, how to learn how to drive, um, about that, right? So it's very funny. You cannot believe me, but I just got my driving license just 3 years ago. So I'm on retirement now, but I only got my first driving license 3 years ago. Why is it? Because I failed two times before that, and I was scared. Right? For me, when I learned driving, it was also complex to me. So many things I need to take care. Because I signed up for the manual gear, not the auto. So it's even worse, right? You have to remember how to pull your gear and then put your clutcher and then the accelerator and the gas and all thing, and then look at the blind spot, rear mirror, and lots of things. And then the teacher to my side here, ready to scold me, right? A lot of pressure. So I failed two times. I failed two times. For I said for name, but driving in Singapore is difficult. I tell you, learning to drive in Singapore is very difficult. So first time I hit the curve and then it's immediate failure, right? So the tester told me that you already failed, right? Second time, it was on the very heavy rain, and then the tester, I think he did a trick, right? He told me turn left. I immediately turn left, but I did not notice that the traffic sign say you cannot turn left here. Turn left is the next one, and I immediately turn, and that's immediate failure also. So that's what happened. What when I took the test and I failed twice, and then finally I only passed 3 years ago, and I think I paid up to $5,000 for all the learnings and the testing. I mean, getting a license in Singapore is a nightmare and expensive, but I got it. But you see, even me, when I learn something that many of you say it's normal, it's nothing, right? But I felt very complex. So I completely understand that if you start option now and you feel very complex, so complicated for you, so overwhelming, it's okay. We are here to help. We design the program in the way that we have the webinar every now and then. We ask unlimited questions and we're there to answer you 24 hours, right? So don't worry, we've been through it. We've been through this experience. We know exactly how you feel, and we continue to improve ourselves to serve you better, right? So that's the whole intent of this mentorship program. All right. So then, now in terms of the whole mentorship program, you have full year access into the online mentorship, where you see Adam, myself, and the coaches to teach you life, right? Continue to revise your skills and help you get on board with very high confidence, right? So every 2 months you will have, if you haven't started yet, but every 2 months you have Coach YY having a live webinar to teach you on how to set up the trading account, place your first trade, how to use the tool, how you get started, things like that, right? So every 2 months he will be there to help you. Now, every other month, I also have webinar. Like tomorrow, I will have one with one strategy, where I have a deep dive, uh, zoom into one specific strategy with example, with detail explanation. So you're not just learning from me and Adam from the pre-recorded online videos, but you also get to learn it live with us on a regular basis, right? So we recap the lesson, we will explain, and we answer all the questions you have along the way, and then that will help you get on board even faster. And then we'll use some examples using the real data in the market to illustrate. Yeah, this is the best thing. You get to attend my monthly e-gathering, right? So every month, and most of the time I schedule it on the last Monday of the month, right? Last Monday of the month, I have the gathering for 3.5 hours, sometimes even like 4 hours, where I provide a market update, where I answer, when I review the portfolio with all the trades that I closed, still on open, the performance of portfolio, and then we get into a list of questions and topics that people have sent in like 1 or 2 days before. So I go through all the questions you sent in, and then lastly we go through the list of the trade ideas, And many times I got like hundreds of ideas, right? So I will went through, analyze all of them, and then I will pick and choose the one I like the best, and I enter the trade live using my own real money. Right? So then after the gathering is over, I wrap up, I summarize it, and then along the month until next time, I keep updating folks with my actions for the trade, right? Either I roll it, I close it, or I do some adjustment, something like that, right? So you will keep being updated by my trade actions every time I take any action on a trade. And then comes next month, I will review the trade portfolio or the trade performance, what goes wrong, what's go right, and the portfolio performance. That's how it's worked. So you see me trading live using my real money. You can suggest trades that you like, or I can use my prepared trade ideas as well. So that's the best thing that you could learn. I tell you, I learned when I learned option many years ago. I do not even get to ask questions from my teacher, though he consider me as the best student he had. I asked him a question, he replied me after a month. And by that time, the information is not relevant anymore. This is something like you get the access to me live. And then you have the access to a Discord channel where you can ask any questions, and we are there to help you, Adam, me, and the coaches discuss ideas, ask any questions, stupid or not, doesn't matter. Yeah. And then every quarter, Adam will have the psychology webinar that helps you manage your psychology part, which is very crucial, I tell you, very important. All right, so Mike say thank you for coaching. You managed 30 to get about 37% return on investment year to date. That's very good. Wendy again, and then Gumit. Okay, Gumit also wrote to me. Thank you for recap. Option Striker level 2 and Option Shell both are very impressive courses. Right? Cat wrote to me and Adams. I have enrolled your class 1 year ago, but never do anything about it until May, and now my portfolio is 23.13% year to date. Right, very good. Tommy, I have achieved 34% year to date using mainly bullish synthetic, classical put, cover call, bull put, spread extreme, and crouching bull. Thanks to Bang and his amazing coaching skill. Also, Tommy, year to date, 34%. Very good. Again, these are the things that we include in the option way riding membership, right? The option Iron Shell level 1 and Iron Striker level 2, you have access to it live. Sorry, live on a lifetime, meaning you can, yeah, you as long as it's there, you can just rewatch it, right? On demand at your pace. 26 powerful option tactics and case studies, right? Email support from the coaches, and then you can always ask question on the chat group as well. And then we have the whole mentorship program where you have access for 1 year, and after that you need to renew. This mentorship covers that what I say, right? The monthly e-gathering where I trade live. You can ask questions, you can suggest topics to talk. You have a deep dive like the one I'm going to have tomorrow, and then every month you have similar one from me or from the coaches. And then you have the Discord channel, and you have the quarterly psychology class with Adam, and you have the bi-monthly with Coach YY on onboarding workshop. Yeah. So the whole thing, the whole package we design, right, is retail at 2,997, right? That's, I think, I mean, the home value is a lot more, but we retail at that price. Now, if you sign up today, very special event, not only getting 12 months access to the mentorship, you have 14 months. So you get extra 2 months there, worth almost $500. And if you enroll it now, this is a very special price, 40% off. 40% off the price that I mentioned earlier. So it is only $1,798. $1,798. I tell you, it's a steal. I mean, when I learned option for the first time, I think 13 years ago, I pay a lot more than this. And they taught me only the basic thing, call, put option, Greeks, and volatilities. That's it. And then I pay another $2,000 for Iron Condor, one strategy. So they put it in a piecemeal, right? Every time I want to learn a new strategy, I have to pay. So I learned only two, the basic and the Iron Condor, and it cost so much. And that is 13 years ago. And now we have everything in one roof for you, including the ongoing support for only 1,798. I think this is something I cannot imagine that you could have this good price. Yeah. And then if you want to renew the mentorship another year, that is $899. Yeah. And then you get extra 2 months if you sign up right now. Right. It just take a few good trades for you to make back on the mentorship program, like what Asanka say, right? I'm pleased to let you know that my portfolio has grown 28% in the last 7 weeks, purely from option trading, which helped me to recover all the cost fee and time many times over, right? So as simple as that, right? Just make the right choice now, and the power to grow your wealth is in your hand. Yeah. So like Toby wrote to me, say thanks, Master, for sharing your wisdom. Yesterday I entered Boonbang on PayPal, up 120%. One of my best decision to buy on courses from Adam back to 2019. Yeah. And Kong say, I beat the market this year for the first time. Alessandra also make 324%, right? By incorporating option trading into his strategy, right? Recover on the previous losses, including the cost and subscription fees, achieve decent profit. My investment and trading journey would never been successful without your constant guidance and invaluable lessons. Here's my portfolio performance. Very good. And Cheryl, 60% return. It took a couple of years, but it's slowly with it. Student is proud to share my 2024 results, 60.7% return across 205 trades with an average win rate of 76.4%. Very good result. Barry, this one, again, making 400K, right? 400K plus 71%. Wow, Miss Barry. Suran, I achieved 36% return in 2024 and remarkable milestone of 101% return on my investment since I subscribed to Value Momentum and Iron Strikers option courses. Beautiful. Again, this just show this screenshot, the QR code here, so that in case you miss it, now you can just sign up to it. And okay, we have a quick break now, maybe 1 minute or two, maybe 2 minutes, and then I will get back with top 3 trading ideas that I'm having on my calendar here. Okay, so just 2 minutes, everyone. I come back. Stop sound. All right, everyone. Welcome back. I hope you can hear me. I don't know your. Hey, just want to check. Can you still hear me or see me? You can hear me, right? I don't know if you can see me because in my screen here, I don't know my video is showing something else. Okay, you can see me. You can see me. Okay, good, good. Somehow I could not see myself. I only see the slide. Okay, so let's move it down. Okay, so if you can see me, it's good. Now let me share with you my top 3 trade ideas that I'm planning for Wednesday when I had the and I will have the live trade hunt webinar. Now things will change, right? When market opens, things will change. But based on the data as of last Friday close, these are the 3 sub trade ideas that I'm having. But when it comes to the live trade hunt webinar on Wednesday, I may choose different one because the data I use today may not be relevant anymore. Just keep in mind of that, right? So the top 3 trading ideas using calendar spread I have. Ready? Now the first one is obvious, right? I have used Google as one example. So obviously this is my candidate that I'm planning, and I have explained the trade how to construct it. So I don't want to get into the detail of this one anymore because I show you enough about this trade. The number 2 is Amazon. Okay, let me switch to my broker's platform here. It asks me to reconnect. During the weekend, the platforms tends to have some technical updates. So I'm loading the thing or swim again. Just bear with me, right? Oh, you say you cannot see my slide? I just want to check. Hold on. So now I'm sharing my thing or swim is loading. Now, just want to check. You can see me and slide. Okay, you can see my slide also. You can see Amazon. Okay, good. You can see my slides, which is Amazon and Google, right? So let me go to my platform. Hope you can see my platform as well. Yeah, good. Hey, Satyaki. Good, my friend. Long time. Okay. Let me go to my platform here and I just type in Amazon. Let me tell you what I'm thinking about this chart, right? Obviously, it's on uptrend. It's reversed to an uptrend already after, I think, a big decline in towards April tariff day, right? It dropped a lot, but now it has recovered. And the recovery has been very steady. You can see here, very steady. You hardly see any big drop from the stock price. So obviously it is on a very strong recovery momentum right here. From the fundamental standpoint, the stock price is near at the value, at the fair valuation, which is 221. But again, trading calendar spread, you don't have to care much about the valuation. Just I have it there for reference only. It's a good stock, very good premium to collect, and liquidity is tremendous. Right? You can bid and ask is so narrow, so you can buy or sell anything you want. Very good stuff to trade, right? So I'm looking at this one, right? I say yes, the supply is recovering, but it's still not clear the new on-time high yet. right? So, but it will get there, and we could see some resistance when the supply approaches the on-time high again, which is quite near from here, right? So then I would, with the stock price rallying over the past few weeks, I would be a little bit cautious here, not to get too much bullish, because we could see some consolidation, especially after the strong run up here. And now the stock price heading to an earnings release as well. So we could see consolidation. So the calendar spread could be a good trade to use in this scenario. So if I want to construct a trade when the stock price at 226, right? So how do I do it? Let me get into the option chain right here, and Amazon, right? So if I use the same construct as I use for Google Trade, right? I would also use the same by January 2026, expiring in 180 days now, right? One day has passed. Yeah. And then the stop price is at 226. I do not have any strike price at 226. So I need to select between 225 or 230. So because in this case, I don't have the exact at the money, I will choose the one that near at the money. So the nearer to 226 is 225. Yeah. So I buy a contract here, call option. So I buy a call option here. Sorry, this not buy a call option here. And at the strike price of 225, which is near at the money, slightly in the money, but nearer to at the money. At the mark price, I will have to pay close to $22, right? $21.93. Yeah, so that is one option that I'm thinking to buy, because I believe eventually this one will play catch up and it will go to a new on-time high eventually. So that is a call option I'm looking at, right? So 225, buy one call option and pay this amount of money. Now, if I just buy a call option, what do I call it? It's a losing game, right? I call it a losing game. You pay a lot of money for a hope that the price will go up beyond your break-even price. Your break-even price will be 225 plus 21. So the stock price has to go to like 246, 247 for you to break even. That's a lot. 247 will be a new on-time high already. So that is a little bit too far-fetched. Yeah. So that's why I call it losing game. To reduce the cost, what I do is I will sell a short dated option. Same strike price, 225 here. Right, call option. And then I will collect $9 for that short call option. And this one will expire on August 15, which is 4 weeks from now. Right. And then collecting for $9.40, that means I will cut the cost down by quite substantial amount of money, right? Almost 35%, right? Let me see. $9.40 divided by 2193. Sorry. 9.4 divided by 2193. 43%. I cut the cost down by 43%, almost half. That's a good deal. So the trade would be buying near at the money, yeah, and then sell near at the money at the same time. Buy and sell. Sorry, I pressed the wrong one. Buy, I click into ask, and sell, I click into bid. Yeah, so this is the calendar spread. I buy one call option expiring in January 2026, near at the money, call. And then at the same time, I sell one call option expiring in 4 weeks, same strike price, same call option, and I reduce the cost of owning the share here, or owning the long con here, down by 40%. Right, so now net I pay only 1,200 for the trade. And to analyze it, so here's the trade that I'm simulating. And if you move this one to the expiry date for the short call, that is August 16. Sorry, that's wrong. August 16. Yeah, August 16 here. That is 1 day after the expiry date. All right, so this trade has a decent profit zone here. You can see the probability of winning is 55%, which is good. Profit zone is between 211 and 246. That is a profit zone. 211 to 246. If I go to the chart, 211 is where? 211 is here, around here, and 246 is here. 246, by the way, will be a new on-time high. So I'm not worried about the upside risk, because the stock needs to break above the on-time high to get to my profit zone, a break-even point on the upside. So this is my break-even point, the profit zone, which is quite decent, right? If I think in the next 4 weeks, the stock price will continue to move around here, maybe up or maybe down, but within this profit zone, my trade will be profitable. Yeah. And then if the stock price rallies, I can always convert the trade into a more bullish trade. And that will extend the profit zone even further. But for now, I'm not worried much on the upside here, because that means the stock price needs to go through the roof. This is the roof, right? Very decent profit zone. And then what is the max profit for the trade if before rolling? Well, the trade will have a profit of $700 if the stock price stays at 225 by the expiration. And then you do the math, right? $700 divided by how much is the capital for the trade? 1253. 56%. Not bad. 56% before rolling. And 56% is for the 4 weeks, right? Now, as I said, I don't expect to make that $700. I could make somewhere, maybe I make $200. It's fine. I have a wide zone of making at least $200 here, right? If the stock price moves somewhere here, I could make $200 or more, right? $200 over 1,200, wow, that would still be very decent. That would still be 15%. Yeah. So not too bad. Yeah. So this is something I am considering of doing on Wednesday. But of course, the price will move, so we need to re-simulate the trade on Wednesday when we enter the trade. So that is my second trade ideas that I'm having on my second trade idea here that I'm having. Number three candidate is Apple. As you know, Apple is one of the mega cap stock that has not participated in the last rally of the market. The stock price has been stalled or stagnant for a period of time now. If you look at the chart of Apple, right, it has been kind of consolidating, going sideways over the past few weeks. And this is a very good setup for a calendar spread. Eventually, I believe this one will break out and will catch up, right? So this is one of the Max 7 stocks that is underperforming the market, and of course underperforming the peer, right? So, but this could be a very good candidate for a calendar spread. The longer it can consolidate here, the better it will do for a calendar spread. Right now, the stock price is still hovering around 211, 210, and it's been in that level for 2-3 weeks now. 211 to 10. So a calendar spread I'm looking at is same. Just sell 210 short dated option and buy 210 long dated option. Very simple. Calendar spread is so simple for the entry, right? Just just select two legs. Long leg, long dated leg, long DT leg, and then short DT leg. That's it. Or long leg, short leg. Okay, like that. Same strike price, and then it will cut your cost significantly. And again, to make it simple, because we need to resimulate it anyway on Wednesday. To make it simple, I use the same construct, right, for Apple, and then we will re-examine it on Wednesday. So if I do the same thing, right, I select near at the money, which is 210, because 215 will be a bit too far. If you are bullish, you can select 215, but I don't know. I just select near at the money, which is 210, because that's where you have the more extrinsic value of the call option. Time decay will be better for the trade. Yeah. So you buy 210 strike here, and in this case, I pay 1800 for it. Right. And then against that, I will sell to 10, expiring same construct. Okay. Or I can choose a shorter DT as well, but same construct to make it simple. And then I will sell and collect $7.70. And I will cut the cost down also by 40%. See, 18, I collect 7.7 back. Net, I pay only $10.70. Yeah, so that significantly reduced the risk of the trade. And if you analyze it, it should have a similar profile as we had with other trade, right? So in this case, you also choose the expiry date on this one, and the trade also have a good probability of winning, 57%, with the stock price somewhere near in the middle of the profit zone. No, I need to reset this one. Sorry, need to reset this the break-even point. Yeah. So now we have about 53% chance of winning, with the break-even staying between, let's call it 199 and 126. So that is a profit zone. 199 to 1. So 199 to 226. Right? So if you go to the chart, 199 is where? 199 is here. The stop price need to drop on the way here to 226 is somewhere here. So this is the profit zone of the trade. Yeah. So if you think the stop price will continue to stay around here in the next 4 weeks, the trade will be profitable, right? This stock tend not to move a lot during earnings, right? Earning it drop a bit, up a little bit, not much. Apple, based on my experience and observation, the stock price does not move a lot on earnings. So this one, I think earnings coming, but I think it's very decent. Yeah. If the stock price goes up, I always roll the short count up. And then with the max loss of 1068, my stop loss would be about $530. 530 somewhere here. So this is my stop loss if the stock price drop on the way down here. All right. So very simple construct, and there's nothing have to be complicated here. Just two legs, long, short, same strike price, and then profit zone looks like a triangle. If the price stays within that, you'll be profitable. If it goes up, you roll the shotgun up. If it drops a lot, you cut loss. Right? If it drop not much, then you keep rolling the shotgun to collect more premium. All right, so that is my 3 top trading ideas, and then I will have one more session before I call it a day today. All right, so now the coming up session will be the Q&A with me. I have received a long list of questions that the team have forwarded to me here via the Google document. All right, for now I have 20 questions. All right, let me cover it. It will take maybe 45 minutes from here. All right, let me go from the first one from Alan. When do you decide to roll the short call of the calendar spread? Very good question. This is art and science at the same time. In general, when you think the supply, starts going higher, roll the shotgun up immediately. Roll it to what level? Well, roll it to where you think the supply will move to by the expiration of the new shotgun. So that's a general rule. So if you enter the trade with the Apple at 210 strike price, but if you sense that Apple price starts to break out to 215 to 20, then roll the shotgun up immediately. The sooner is the better. The sooner is the cheaper. Because if you roll too late and the price already rallies, then the rolling will be costly. You will need to pay a debit, like what I paid for the GameStop, right? The first one, it moves like $6 a day after. I have to roll it up for a debit. So that is a situation. But if you roll early enough or you roll not much up, then you could collect a credit for the rolling. When you roll for a credit, you reduce your cost of the trade. When you roll for a debit, you increase the max risk for the trade, right? So again, it's a little bit sensing, judgment, read the chart and make your own decision. There's no right or wrong here. If you think the supply will start move up very fast, roll it up immediately. But if you have no idea, wait for the delta of the shotgun to exceed 80 and then roll. This is what we taught in the lesson. From Peter, Peter Pham must be another Vietnamese. Hi, Mr. Bang. In the example of calendar spread for GameStop just now, when rolling, sometimes you don't keep the calendar spread, but switch to another strategy. That is correct. So remember, I started with the 18 strike price calendar spread. Unfortunately for my trade, after I entered, the day after, the supply went on the way to 24. So when I roll the short con from 18 to 24, but I keep the long con at 18, right? So my trade will become a diagonal spread. Long con at 18, short con at 24. So it's no longer a calendar spread because now you have two different strike prices. And that is diagonal spread. So that is right. What you say is right. I convert my trade into a diagonal spread. Jun Yeo asked question here. Generally, we roll because the stock went above the sell call. So every time we roll, we are typically in the red, isn't it? And every time we roll, it eats into the profit that the long con is supposed to be earning, isn't it? Yes and no. Okay. Now, depends on how long you have been in that trade. So in the case of GameStop, I just entered today and tomorrow it already moved 6 points. Then I have to roll for a debit. In that case, I lost more on the short con than the profit I made in the long con. So that's correct. But if you have been a trade for few days, time decay benefit already kicked in, right? So, and now the price starts to move. Then chances are when you roll the short con up, you roll for less debit, or you can roll even for a credit, right? And therefore you make more money in the long con than the short con, right? So it really depends on how long you've been in the trade. Have you got any benefit from time decay or not, right? And then how far the supply goes beyond the short con. If you let the price goes too much further above the short con, yes, the short con will be losing money more than the benefit of the long con. And in that case, remember the chart of the calendar spread, the price goes up so much that will fall into the loss zone in the upside. All right, so you need to be very nimble with the rolling. KW Light ask question here for GME trade. When you roll, you either roll up or down the strike price, depends on the price movement. and you roll the expiry date forward to, is that correct? That's correct. So when I roll it, right, most of the time I will roll my call option up and out, because if the stock price goes up, right, you roll up and out, you will be paying less debit, or you can collect a credit like the GME. I collected credit because I close the short dated call option and I sell to open the new one, longer expiry date. So I collect more premium from that. And that I collect a credit for it. So most of the time I roll up and out. Yeah. Occasionally I roll up, but I keep the same DT. Then in that case, I pay a little debit. But most of the time I roll up and out. Alan's questions. When do you decide to roll the shotgun for the calendar for the calendar sweat? The same answer here. Whenever you think the price starts to move up, roll it immediately, because that will be cheaper and that will be better for the trade. If you let the stock price goes up already too much, then the rolling will be very costly. Okay. Helena, say thanks for sharing many successful story. Do you have unsuccessful story from students? Why were they unsuccessful? My own story includes both losing, lessons and costly mistakes that I made as well, right? Not just the example of buying call option on Apple and lost $60,000 in one day. That's a very painful one. In the mentorship program and level one and level two particularly, I share with you many costly mistakes that I made, right? Very painful, very costly. The intent to share on this costly mistake is to help you avoid, and you can reduce the cost, the learning curve that I have to pay. Yeah. So I do share costly mistakes also. So it's from Eric. May I know for calendar spread, what do we do if the second leg, which is the naked call, is a sign? Do we sell the first one leg also? Very good questions. Okay, so the scenario is, for example, if I enter a calendar spread on Apple with 210 strike price, and what if the stock price jumps tomorrow to 240, right? And the short call 210 there will be deep in the money, right? And because it deep in the money, the option can be assigned, right? Because the time value in it is already depleted, and the call option buyer there can decide to exercise his option, and therefore I will be assigned, right? So Eric question is, do we sell the first leg also? Don't. Okay, so in that scenario, don't sell. Okay, so how to solve that? First of all, it is extremely rare that you will be assigned immediately when the supply rallies. Very, very rare, because even if it dip in the money, the time value in the option is still there. And if the time value in the short option still uh, meaningful, the option buyer will not be stupid to exercise his or her option. Okay. In my experience, I don't recall I ever get assigned from the call in that context. Now, even if you face that situation, don't be panicked. Nothing, just nothing. Just because you get assigned the short share, right? Just buy the shares to close the trade. And then you can close your long con at the same time. You sell your long con, exit the trade, probably for a loss. But because your loss, the max loss in the trade is predefined, you know exactly how much is your max loss. So in the case of Apple, my max loss is 1200, right? Even if I get assigned, it won't change the max loss of the trade. right? The max loss of the trade is also still 1200. So what you need to do is just buy back to clear the assigned short shares there, and then sell the long call to close the trade. Yeah, probably you lose 1,000, you lose 900 something. And by the way, in the videos that I have there for the option assignments, we cover all of this. So don't be worry. Once you watch it, you don't have to worry about the assignment anymore. Jack, they say, ask question, would you recommend using calendar spread and diagonal spread on SPY and QQQ? My answer is yes. Yeah. So if you, I mean, in the long run, right? You have QQQ and SPX goes up in the long run. But in some period of time, you will see the market consolidating, like we see SPX or SPY over the past few days. It had been consolidating, right? It could be a good time for you to enter a calendar spread, earning premium while you're waiting for the next leg up. And then when SPY is ready to move up again, then you can convert your trade into a diagonal spread. And then if you are already bullish, of course, you can enter a diagonal spread. I have no issue with that. And QQQ and SPY has very good liquidity. They have very good liquidity, so your option premium is nice. I think it's okay. I did it also. I did it on SPY and QQQ. Rob asked question here. My question still stands. What if the short call option is exercised early and you don't own the shares? Will you have to buy the shares at the higher price to supply to the call buyer? Okay, same question with Eric asked earlier, right? So in this trade, you don't own shares, so that's correct. So what happens if the share price goes up too much, too fast? Your short call will be assigned, but you don't have to worry. The broker will not force you to close because you have the long call with worth much better than the short call. So then the risk is capped, so the broker will not force you to close a position, of course. But sometimes, I mean, if they deem that your account is too small, they can force close your position. But they have typically they have enough time. They give you enough time to take action. So in that scenario, you just buy the shares to close it, and then sell the long call to close the trade, probably for a loss, right? But your loss should not be more than the entry debit. So yes, so Rob, yes, you will have to buy shares at a high price. That's correct. But your long call option at that point in time also appreciate in value, right? So you can sell your call option at the profit to offset with the loss in the short call. Yeah. So chances are in the loss in the short call and the assignment, and then you have to buy the share to close it. Perhaps let's say you lose $2,000 in that, but then you sell your long call for a 1,500 profit. So net you still lose $500. Yeah. But again, when you trade a spread with two legs or more, don't just look at the loss or the P&L of one trade and freak out because of that. You always look at the P&L from the combined two legs, right? Or on legs combined. Okay, so Richard, you say, hi Bang, you said you lost money for the call option. Can you please talk a bit on the hedging? How do you do it? I don't recall. I only told you one story when I lost money when I bought Apple call option many years ago, 2006. And since then, I mean, since I learned option properly, I do not buy single call option anymore. Occasionally I bought VIX call option, but that's it. But I don't buy stock call option just like to hold it with the hope that the stock price will go up. I don't recall that I say I lost money on call option now. Only one incident I talk about, that is when I bought Apple call option. That's before I understood how it works. And can you talk a bit on the hedging? I don't know. If you buy a call option, by right it's already hedged, right? You cannot lose more than the premium you pay. There's no point to buy another protection or hedge against it, right? So when you buy a call option, you know exactly how much your max loss. You can sleep very well because you know that is the max loss you can lose. Yeah. Vương Tong asked question here. So if I understand well, you would be selling shorter DT corn along the way to choose profits every month until expiration of the corn you bought. That's correct. When selling another corn and the price went up, would you sell at the same strike price or the new current strike price, right? So if the share price stays the same, I sell at the same strike price. But if the share price has gone up, I prefer to sell a higher strike to create more headroom for my trade, converting my trade into a diagonal spread and eliminate the loss zone on the upside. So that's what I do. I prefer to sell a higher strike price in that scenario. Should we roll and collected as much premium paid on the corn paid? It is essentially means that we can no longer lose money on the trade, but benefit from any upside if the price moves above us. So if you sell a lower call strike, you collect more, but you will cap the headroom for the upside. If you sell a higher strike call, you collect less premium, but you have more risk, more headroom for the upside. So it's a balance between the two. You have to judge on where the stock price go, and then ideally you just sell at that point, the point you think the stock price will move to. So that means you need to have a lot of guessing. Right? So that's something you have to develop over time, sensing where the price goes and then roll the shotgun to that level. KW Light asks, when do you finally decide to close the position for the GME? That would what was the considerations when you make that decision? I if I remember correctly, for the GME trade, there there were two reasons why I closed the trade. One, the long con is approaching 30 days before expiry date. So I don't hold the long call too close to the expiry date because you know the time decay will accelerate towards the 30 days, right? So when the long con is less than 30 days, I tend to close the trade. And the second reason I remember because the the trade has hit the higher end of my profit target. So my profit targets normally start at 50, right? If you get to 100, it's already very good. So in this case, I got 112%. So it's already at the high end of my profit zone for my profit target. So that's a good money to take. Okay. Next one, Grace Lee. Hi Bang. Is it a good use? It's good. Is it good to use this strategy, calendar spread, on UNH while waiting for the stock price to go up? I think, let me take a look. I think it's okay. I think recently this sector has got beaten down quite a bit, right? So if you ask me, right, I would wait for some sign of recovery first. Ideally, I would want to see a bullish spin bar, right? A bullish spin bar typically like this, right? It dip and then recover, or bullish spin bar can be a white candle like this, right? So bullish spin bar just show some sign of reversal or stabilization. Then that's the time I probably prefer to enter a calendar spread. But when the stock price continue to go down like there's no tomorrow, like this, I would wait. I would wait because the selling forces are still very strong, right? So wait. The stochastic here, another indicator I'm using, just shows that the stock price really oversold. So eventually it will be rebound, right? But there's no sign of decline being stopped yet. So I would wait to see the bullish candle first before I enter the trade. But premium for you, premium for UNS is good. Jack Tan asked question here, assuming if I start my option trading account with 10K, how many option contracts I can have at one time on average? Just general question to see how much I have to leverage, if my question makes sense. Yeah, it makes sense. So if you have 10K, right? So one trade like Canada spread here could cost you about 1,000 to 1,005, and that would be good for 6 months, right? Um, Obviously, you don't want to have only one trade. You have maybe five trades. Maybe let's say you use half of your capital, 5K. You can enter like four trades, and then each trade you have one contract. For me, normally I have more than one contract, right? For calendar sweat, I have 5 contracts. But if you start with 10K, probably you just need to have one contract for each trade, and you can do 4, even 5 trades, right? And still leave some capital there in case you need to use for something else. Yeah, I think it's a good start already, 10K. Jack asked question here. If I enter a calendar spread on the first month at Bicon 185, DT 180 days for $17, Cellcon at 185, DTE 30 days and collect $7. So that's Google. Why Google at 185, 186? And the second month, Google is at 195. Do I close out both legs at the same time? Because rolling the sell con would incur a loss. Or if I don't close the buy con together. No, no. The way you manage the trade is you're not closing the long con until you hit the stop loss, right? So in this case, you just manage the short con. So if I go back to the Google trade here, if I have to go back to the Google trade. So go back to the Google trade, and this is a P&L chart, right? And the profit zone is between 173 and 202. Now you say if the stock price go to 190 or 195, do I have to close both leg because the short call will be losing money? First of all, again, when you trade options with 2 legs or more, don't just look at the loss in the short call. Look at the loss in the short call plus the profit in the long call. Combine the two. Your trade should still be profitable. Why? At 180, 195 here, the trade would still be profitable, bro. At the expiration, your trade would still be profitable. That means the loss in the short call is more than offset by the profit in the long call. Your trade, you still be profitable. And that is the most important thing. When you trade, just don't look at the P&L of one leg and freak out of it, right? Just look at the combined P&L of 2 legs. In this case, your trade should still be profitable, right? And then if you want to create more headroom for the upside, you can roll your short call from 185 to 195, and you just convert your trade into a diagonal spread like this with no risk on the upside. Create more headroom for the upside. When you roll it up, you could pay a little debit. Sometimes you can roll it for credit, as I did for my GameStop as well, right? So it's not something you have to worry about. Nothing. Don't close a long call. Only close the boat. I only close my trade when the stock price dropped significantly and hit my stop loss, which is 50% loss. That is the only scenario when I close. Or when the long call time is running out, less than 30 days. Hong Chu Si asked question, Mr. Bang showed he collected premium on short call, but what happened to long call? Long call, long call will lose money, but the time decay will be very slow. But very importantly, when the stock price goes up, right, the long call will benefit more. The long call will earn, right? The long call will benefit with if the stock price goes higher. Short call, will, because you short the call, when stock price goes higher, you will be losing on the short call. But the time decay in the short call will offset part of the loss, right? If the stock price moves up gradually up, the time decay could be more than enough to offset the loss, right? From the price moving. Yeah. So overall, look at the P&L of the trade here. Combine two legs. Don't just look at one leg. You don't even care about the profit or loss of the long call. You don't even care about the profit or loss of the short call. What you care is the combined P&L of two legs. That's all matters. When you trade, like, that's it, right? So when you rent a house for 6 months with the intent to, or when you lease the house for 6 months with the intent to rent it out on a monthly to collect rents, right? Why do you care about every month you lose $1,000 on the lease? You don't have to care about that. What you care is to find a tenants to get the premium to collect rent every month. And the combined P&L, the cost and the revenue will be your profit, right? Not just look at the cost, you have to look at the revenue side also. Yeah. Isaac with ask question here. With calendar spread, since the sell call is near at the money, will it be assigned before expiry date if price hits the strike price? No, again, Isaac, this is very basic, right? If the at the money right now, if I enter the trade right now, let me go back to the option change. Yeah, maybe this one. If I go to my option chain here, what do I have? The short call, if I sell the 185, technically 185 right now is in the money because the stock price 185.06, so it's in the money. Are you saying that the call will be assigned? That would be very crazy. Why? Okay, put yourself in the shoe of the buyer of this call. Now you are the seller. When you enter this trade, you're the seller of this call option, right? But just switch your role. If you are the buyer, of this 185 call, why do you want to exercise this call? So exercise this call, what does it mean for the buyer of the option? It means that the buyer of the call option here can buy Google share at 185. But the moment he exercises this one, he will lose on the premium. So he will be doing something like really stupid because his cost will become 185 plus 7.75. So 192.75. So why does he want to buy share at 192.75? Why don't he just go to the market and buy it at 190, 185 here? So if your counterparty, the buyer of the call option, don't do that stupid thing, then you don't have to worry about the call option being assigned. Right? You are the counterparty, right? Your counterparty doesn't want to do it, then why you have to worry about your side? In fact, you should be open up a champagne to celebrate because that means that stupid guy give you $770 for free. He do something stupid, and then that money becomes your profit. You don't have to wait for 4 weeks to earn this money. You can earn that money immediately. So, Isaac, that's how it works. Again, Isaac asked question, what if the price goes to 195, 18, from 185 to 190 in 2 weeks and sell corn at 195? Will the long buyer corn still remain? Yes, the long corn still remain at 185. You only roll the short corn up, right, to 190, to whatever price you think the stock price will go to, right? Creating more headroom for the upside, converting your trade into a diagonal spread. That's what you do. You only manage the short call, not the long call. Henry Koo asked question here. In your account, what is the percentage of portfolio you keep as cash at any point in time? So general rule, I keep about 30% cash. I No, not the right word to say. 30% unused capital. Yeah. Because sometimes I put the cash in the T-bill and stuff, right? So it's not cash anymore. Yeah, so unused capital, I'm target to maintain at 30%, right? If I'm bullish on the market, I tend to trade more and I can use up to 85% or 90%. So I leave only 10-15% left, right? If I'm bearish, I think the market is going to be volatile like during the tariff day, liberation day, right? I even keep like 50% unused capital. So it really depends on the market situation. I typically keep it at 30% unused capital there. Fion asks question, I'm very new and know nothing about options and hear that option is dangerous and will get burned easily. I have zero knowledge in this. Does this course require a lot of calculations? Because I am not good in math. All right. I completely understand your concern, Fion. You say many people say option is dangerous and you could get burned easily. I could say the same thing for driving, right? When I learned driving 3 years ago, I was also very nervous. I find it very dangerous as well. If I just take a wrong turn slightly, I could get an accident, right? And there's so many things for me to think about, okay? This and that, and have to. So everything is complex at the beginning. When you learn something new, it's always very complex. And there's no free lunch. You need to go through the whole learning process. You do not need to be good at math, right? And you just jump in. We have so many members who say the same thing. They're not good at math and they keep collecting good profits. So earlier today, you heard Adam talking. What is it? Uh, what's one lady? Felicia, or yeah, forget the name. She's have no background on financials, but now she collecting premium where she's traveled the world, right? So it's not like something so dangerous as people tend to say it when they don't know it. Okay, when they don't know how to use it, they tend to think it is dangerous, right? Um, the same can be said to using a knife, right? Using the knife can be very dangerous if you don't know how to use it. But if you know how to use the knife, it can be very helpful, right? For you to cut the meat, you to peel the onions and stuff like that. It's all about learn how to use it. If you don't use it properly, yes, it can burn your account easily. Sure. It's like if you don't know how to use the knife properly, you can kill yourself, right? Or you can kill somebody. Yeah. Just use that analogy. It may not be the right analogy you use, but I tell you that everything looks very complex at the beginning. But then you jump into it, you learn, and you find out, hey, actually, this is very safe. To me, if you ask me now, after knowing options, option is much safer than stocks. Because as I say, if you trade stock, you use stock, right? It gaps down, it doesn't protect you even if you have a stop loss. But if you have option, you are guaranteed that you won't lose more than a certain amount, right? To me, option is much safer. All right, so there are 20 questions that I got in my Google Sheet here, and I hope I cover most of questions there, and the coaches are there to help as well. Okay, I have a few more here. Maybe I answer a few more, and we can call it a day. Yeah. Let's see, yeah. Mandi, what do you think about NVO? Can we buy call option now? Again, back to my lesson, right? To me, buy a call option is a losing game. Okay, I explained it enough. I have experienced that one painfully, and just don't buy a call option. And NVO, I showed the chart. It's on the still a declining trend. I don't think it's a good idea to trade a bullish strategy on it. Yeah. Okay, Molly. Oh no, I think just what this 3 hours ago. Unless he just repeating the same thing, I'm going to leave now. Someone did answer. Someone. How I would answer my. Okay. Patrick, hope I understand the concept during the course. Okay. Iris, what is the cost impact if one forgets to close the long call? Okay, first of all, when you trade option, please don't forget to manage it, or don't forget when it expires, because a lot of implication can happen, right? So, for example, if you let your long call expire in the money, you will be assigned shares. Yeah, you will be owning shares. Yeah, so that's you need to make sure you have cash ready to take it. Uh, if you forget to roll the short call and the short call is in the money, you will be assigned short shares, right? So in that case, you need to buy shares to clear it. So when you trade option, you need to take care of the trade, right? It's not something you can buy and then go for a vacation for 2 months. It's not something like that, okay? You invest in stuff, you can just buy and forget. That is true. You don't care, right? The market goes up or down, but option has an expiration date and you have to take care of it. Okay, Casey asked, I still confused with the short gone for weeks. If Google share price up to 190 higher than the strike price, the counterparty shall come back to buy from the seller. I told you, right? Okay, so this one, right? First of all, your trade should still be profitable at 190, right? 190 stuff. Now, whether the call buyer will come back and exercise or buy the shares or not depends on how much time value left, right? So if I add one column here called extrinsic value, or sometimes we call it time value as well, and then you will see it clearer, right? So let's say a call buyer at 185 strike here pays $7.75. And then after a few weeks, the stock price goes on the way to 190, right? And his call option premium will go up. But if this extrinsic value still have like $5 or something, it is very highly unlikely that he will want to exercise. The moment he exercise his option to buy the share at 185 here, he will need to forfeit all remaining extrinsic value in the option. So in this case, still $500, $550 in the extrinsic value. Now, if the share price goes to 190, this extrinsic value may go down to, let's say, $3. $3 still like $300, right? So if the short the call buyer here exercise his option, he will forfeit this $300 time value. Then you, as a counterparty, you will get this extra $300 and you don't have to wait until the expiry date. So in that case, yes, you will be assigned, but it will be a very good deal for you because this person decides to leave some money on the table and you just grab it. So you don't have to worry about that. All right. Do you hold your candle spread through earnings or is it before that? Depends. If I think the stock price doesn't collapse or moves a lot, I will hold through it. So I will look at the historical price action after the earnings, and I see if the stock has a historical like muted after earnings. I don't mind. Yeah. or if I have a wide profit zone like Google, like Amazon, I don't mind. I don't mind because the profit zone can covers a significant stock price movement after the earnings. Yeah. So Eugene, I will sell my shotgun when the current one expires. Correct. That's the intent, right? So you lease the house for 6 months. Every month you rent it out to a tenant, and you need to find a new tenant, and you rent the house to a new tenant every month. That's correct. Okay, I don't know the how long the video will be there, so that's the admin will take care. Yeah. Do you use spy strangles? I used to do strangles, but I think it's very dangerous strategy because it have unlimited upside risk and downside risk at the same time. You have risk in both sides. If you sell a strangle, right? So you sell strangle, you sell a con, you sell a put, that will put you in a situation where you have unlimited risk on the upside and downside, and that is dangerous in my opinion. Yeah, I prefer a risk defined trade where I know exactly how much is my max loss. CS is a bullish trade or neutral trade. As I said, it can be used as a bullish trade, bearish trade, or neutral trade. In most cases, I use it as a neutral trade. But if you are bullish, right, you can select a higher strike price, the out the money strike price. That will make your calendar spread more bullish. Okay, so somebody asked about Wave Rider include my trade idea. So I let the admin team to answer on the admin questions. Okay, I will focus on only on the strategy thing. Okay, you asked a question, I think a valid question. If there's a major flush, the stock price went up suddenly beyond my profit zone, what would I do? Right. So now obviously this scenario happened, right? I experienced it when I trade calendar spread on hymns, hymns and her. And went like that parabolically and obviously get out of my profit zone. So the way I manage is I roll my shotgun up, and occasionally I pay a big debit for the rolling, but the stop I kept rolling, kept going higher. Then eventually it will go out of the profit zone of the trade, right? So then I will close my trade for a loss. So that's what happened occasionally. We do not see it very often. Okay, so Farid, you say, meaning if use calendar spread, the obligation to sell shares no longer applicable for the sell call. No, you still have the obligation to sell call if your counterparty decides to exercise his or her option. But he or she will not do it most of the time. Very highly unlikely. Because that means if he or she exercise the option, the person will need to forfeit on remaining exchange value, and that will be in your favor, right? Very highly unlikely you see that happens. My cell avgio being my cell avgio being called away and become a shorting counter originated from a diagonal spread. What should I do? You just buy to close the assigned short shares and sell the higher call to reinstate the trade. No issue at all. Hey, Sadyaki, you going back to a POE. Seller we have to buy from market seller. The seller will have to buy from the market to sell the seller to buy. Yeah, so if you get assigned, that means you will be assigned short share, right? So what you do is you go to the market and buy the shares at the market price, probably at the higher price, and clear your assigned position. But again, that is nothing because you have the long con to protect you, right? You will not lose more than the premium you pay. That's it. Even if you get assignment, it doesn't change your max loss in the trade. That's the important thing. Assignment or not, you don't care. You know exactly on one trade, you will not lose more than the premium you paid. Yeah. If you get assigned, buy back, clear it, doesn't matter. Your loss should be less than what you paid as a debit. No problem. I use the stochastic full, right? Just go to setup, just use a full stochastic. Okay, Lily, thank you for the support. Reclam, the calendar spread looks similar to iron butterfly. Reclam calendar spread looks similar to iron butterfly. What's the difference? Different to me it's different. The chart may look the same, but iron butterfly you don't roll because four legs in the iron butterfly have the same expiry date. You have no ability to roll. IP, you say again, is 0DT and condo valid for income generating? Now, I used to be against this one, but I can understand why people tempt, very tempting to get into 0DT. So I'm not saying it's good or bad. We're not teaching it in the curriculum here, so I I need to experience myself to see if it's a good idea or not. Right now, I have no comment, right? But I understand that it's getting more popular and but people also, some of them make good money, some of them get burned also on 0DT. So be careful. Just that. Nicholas on CS, what happens if there's a black swan event and share price drops greatly? How would you manage your long contract? Again, that's the best thing, right? If the black swan event happens, the stock price drop by half, for example. If you hold share, you will be very worried and you will lose your sleep maybe, right? But kind of spread, you can sleep very well because you know, even in that scenario, you will not lose more than the max loss, which is the entry debit. So you lose $1,000 if in the worst case scenario, right? But if it doesn't hit $1,000, you can exit it. You lose 800, you lose $700. Yeah, just close the trade both legs because a moment it exits your 50% max loss, just exit it. Do you use scanner to find stuff for candle spread? I use my own eyeballs here. I mean, I find sometimes I use scanner. It give me a very funny, weird kind of stuff, low liquidity, many names that I never heard about. Very hard to trade. Yeah, so I have a watch list where I just go through manually every day. What is the percentage of your trade in your calendar spread? It's not high percentage because calendar spread doesn't use big capital, doesn't use capital. So in terms of capital usage, it's not a big one, but it depends on account. Certain account I use maybe 30%, 40%. Some account I use maybe 10. Yeah, but because of the nature of the trade, it doesn't require a lot of capital. Yeah, for the stochastic, I use the default one. I can show you here. So I use stochastic full 80, 20, 3, 5, 3, high, low, 3 exponent. You can do a screenshot. So this is, I find very reliable to me. Okay, last few questions and we call it a day. What are the risks of bullish synthetic option strategy and how to? So the risk of bullish synthetic, the one that Adam mentioned this morning, the risk is exactly the same with trading stocks or investing in stocks. You have unlimited upside gain potential and you have unlimited downside risk as well. I mean, at least it stops at zero, right? So exactly the same. You see the P&L curve exactly like you holding 100 shares. So that is the risk, right? You have unlimited potential upside and then you have tremendous risk on the downside. How to manage it? If you use it as a trade, then cut loss at the stop loss that you have in mind, right? So you use stock to do swing trade, for example. You know where's your stop loss, and then when the stop price hits that level, you stop out. Nicholas say on CS, please confirm. It sounds like the adjustment are on the basis of share price increasing. Do you manage the short call leg strike upward, but if share price declines, there's no management but closer? Now, that's a good question. So if the stock price drops below the strike price, right? If it doesn't hit the 50% stop loss, I will keep selling the same strike price. So Google, let's say it dropped to 180 or 175. What do? I keep selling 185. I don't sell below the 185. Yeah? So the 185 is the floor. So I keep selling 185, expiring 2-3 weeks or sometimes 4 weeks, collecting more premium or waiting for the stock price to rebound. That's what I do until the stock price hits a stop loss. If it doesn't, then just sell new option, buying time for the stock price to recover, and many times it just recover. All right, so looks like I have answered many questions there. Farid say thank you. Yeah, just a question. Ethan, if my bullish synthetic expires date is very long for good stock, does that mean the risk is okay? It's important questions from Ethan. I need to answer. If my bullish synthetic expiry date is very long for good stocks, does that mean my risk is low? Again, when you have the bullish synthetic, the risk is on the downside, right? If there's a big black swan event, you have no protection on the downside. It doesn't matter is long DT or short DT, it doesn't matter. You have no protection on the downside, and that's what you have to worry about, not when it's expired or not. The bullish synthetic, if you enter the trade, DT is not important, right? Whether you choose 6 months, 9 months, or 2 months, or 1 month, doesn't matter. Or if you select a higher strike price or lower strike price, the P&L looks exactly the same. It's all about whether you think the risk of the stock price going down will be high or not. That's it on the downside. Not the DT, not the strike prices. Hi, Bang. Bullish synthetic spread. What is the strike price and expiry? Again, doesn't matter. You can choose in the money, out of the money, at the money. You can choose 1 month, 2 month, 9 month, 12 month, doesn't matter for the bullish synthetic. That's very unique about this strategy because the long call premium will be paid for by the short put premium. So it's wash out, right? If you buy and sell at the money. Now, my preferred strike price would be at the money because the liquidity will be better. Yeah, liquidity will be much better. All right, looks like I have answered all the questions here, and it's 5:20, everyone. I hope it is helpful, and let me see if I have any final slide left. I don't know. I think I cover everything. Yeah. So this is the last one, and then I hope I am looking forward to seeing many of you in our community soon. And for those of you who sign up and joining my webinars, so I have one tomorrow for skill revision. I think I will talk Bunbang or Bunbang color. And then next Monday, I have e-gathering for own folks who have signed up. I think you sign up now, you can also join my e-gathering. But e-gathering will be more beneficial if you learn already. If you are completely new, you can join in and listen to what I say. Okay. All right. Thank you, everyone. Have a good day. Have a good rest for the rest of the weekend, and I look forward to seeing you in the community. Thank you.
Recording stopped.